perfect now? One minute. Yeah, perfect. I guess everybody, I think for me here because it was not updated yet. Yeah, got updated. So hi friends, let's begin the day before exam income tax revision, and I hope you have seen the name Godfather of all the revisions. Trust me, the next 4.5 hours that we are going to spend here, like it will be like a cherry on the cake. Whatever the level of clarity you have in income tax until now, beyond that I will give you all the dots connected. I don't know whether you studied, whether how many total income problems you solved, 50 problems, 30 problems, 100 problems, it doesn't matter. If you are able to follow this particular, PDF which I'm giving, by the way, look at the video description. You will find a Google Drive link. You just open that Google Drive link and you will find these files. There is a 6 pages file where I listed out what are the provisions that you must read before exam under income tax. Don't worry, all these provisions we are going to discuss. We are going to revise it with lots of clarity, with numerics. I will take so many numbers and give examples, practical examples, all that. Trust me, day before exam, whatever the income tax paper you are going to write, you will perform rock solid. Trust me. And coming to, yeah, I know the law paper was very tough, one of the toughest paper in the history, September 25 law. And just yesterday we uploaded something called exceptional questions in law. From that, more than 35-40 marks came. 1 hour video we uploaded. And whoever followed our 3/4 strategy video, where 70% of the chapters fully they studied, they will not have even 1% problem in this particular law paper. Anyhow, we already gave a law paper review with answers. We already published. That's it. Fine. So without any delay, let's begin the first topic. I just want every one of you to have this PDF, or if not, later you can download and keep, not an issue. You can just follow in this particular video. Now, these are the topics which are must revise sections as well as exceptional. Like exceptional I named because these are the places where you will be doing lots of mistakes. Okay, I will tell you what are all mistakes you do, and I will tell you why, how it should be avoided. Everything I'm covering. Now the first one I'm going to start is approach to total income. But before that, in this PDF, all the 13 chapters that we have in income tax, we have totally 13 chapters. In each and every chapter, what topic to study, which section to study, what are the crux points in each and every section. Crux in the sense where you will confuse. All those points I am listing out here. You see, every chapter I listed. All these chapters, all these sections we are going to revise. And by the way, any of you whoever is already watching my previous marathon, whatever I uploaded, that is also relevant. If you are comfortable with it, go with that. If you want to go with this, come with this. Trust me, you get the best experience. Now, the first one, you know very well, in income tax, the first question is straight away total income problem, which is 15 marks question. First question is straight away 15 marks total income question, right? In income tax. Now, how to solve the total income problem? What are various checkpoints in total income? What are various checkpoints? Now look at. First thing that you need to identify, whether the SSE is an individual, and if so, what is the residential status? 99.99% for us, individual related total income problem only will be there. Very rare partnership firm total income problem can be given. Mostly the first problem will be individuals related, that too resident individuals related. We don't have non-resident taxation in CA inter level, so non-resident based complete total income problem they will not ask. Second one, the second thing immediately you need to identify is what is the regime. What is the regime? Is it default tax regime or optional tax regime? Here, in the question they will use something confusing word. SSE exercised option of shifting out. SSE exercised option of shifting out. Exercise or option of shifting out means what? Shifting out of default tax, nothing but optional tax regime. Another words will be there. SSC not exercised option of shifting out. Not exercised option of shifting out means what? He is going with the default tax regime. Or sometimes how it's straight away simply they can give, SSC wanted to go with the default tax regime 115, BAC. Sometimes they will give SSC do not want to proceed with 115 BAC. Okay, SSC want to declare income, SSC want to pay tax under optional tax regime. Like that they will clearly tell sometimes. But sometimes if they have to make it little confusing, exercise the option of shifting out, not exercise the option of shifting out, like that they will use confusing wording. So be clear. Identify the regime. The moment you identify the regime, all dissolvents, everything that you should keep, you should get in mind. Okay, don't worry, what are all the consequences of default tax regime we will be discussing. Then identify the major head, because the first question 15 marks question, no, the entire question will be predominantly based on one major one head of income. Predominantly 99.99% it will be PGBP based. 99, most of the exams I saw in the past 20 attempts, if you see, almost I can say 17 to 18 attempts. Okay, PGBP is the base problem. Total income problem is mostly PGBP based, means predominant major head is PGBP is what they test. And sometimes, rarely, the total income problem 15 marks question will be salary based. But in every exam 6 marks question will be there on salary based. On a salary based question, either 6 marks or 8 marks will be there in every exam. But 15 marks question generally will be from PGBP based. Very extreme rare cases, capital gains may be the major head in that problem. In a 15 marks total income, in extreme rare cases, capital gains base can also be there. Now, within PGBP based, there are two types of models. P&L account they will give you and ask you to compute total income, or sometimes receipts and payments account they will give you. One is P&L account they will give you, or receipts. P&L account is generally given for business SSCs. Suppose if the individual is carrying on business, P&L account will be given and you have to compute total income. First you need to figure out PGBP income, then other heads income, and then gross total income, all that. Don't worry, we will be discussing all those steps. Receipts and payments account sometimes they will give. When receipts and payment account is given, generally receipts and payment account is given for individual engaged in professions. Suppose total income of a doctor, total income you need to compute of a chartered accountant. So generally if professional people are given, receipts and payments account will be given. So PGBP will be the major one. Now when P&L account is given, dissolvences concept will apply, obviously, because add back will be there. First you will start with net profit, then add back. What are all to be added back, all that I will discuss it in the PGBP section. So we have a separate chapter wise discussion in the same full length video. Okay, so in that PGBP related discussion will come. There I will discuss in depth about all the dissolvences. Next, so these are the main important observations initially you should keep it in mind. Now first compute major head income, like whatever PGBP head of income, whatever is there, first compute. Like how you should do, what is the presentation format, for example, they give you total income, you need to put heading clearly. Some students know, please, question number 1, okay, question number 1, even in the margin also keep heading, computation of total income of Mr. X for assessment year 25-26. For the September exams, for the September 2025 and even January 2026 also, the assessment year will be 25-26, previous year will be 24-25. This is the year based upon which the questions will come. Okay, so computation of total income of Mr. X for the year. Now headings, particulars and amount. Now here, no, based on once you read the question, you know what are the heads of income present. First list out income from salary, income from house property, PGBP income, capital gains, income from other sources. So now you will get here gross total income. Yes or no? From this chapter 6A deductions, remember chapter 6A deductions you will get when you are opting for optional tax regime. If it is default tax regime, chapter 6A only 3 sections will come. Don't worry, this is just an introduction I'm giving you. I will go each and every point in depth. Okay, so first I'm telling you the structure to follow. I hope you're able to understand, and I'll be very happy if you like the video and also comment, participate in the live or in the below normal comments. If you comment, it'll be more good for me also, so I'll be able to understand whether you're able to follow me or not. Chapter 6A. Then what you will get is total income. This is the format. Okay, then here you should put computation of tax liability. Okay, fine, wait, I'll come to it. Now for each head of income, working note 1, working note 2, working note 3, working note, 4 like that. For each head of income, maintain a separate working note. This should be the structure of the first page. Total income, first page. You should not write fully everything. So, first, you see, the moment the examiner open your first question answer, okay, brief summary, okay, gross to head-wise breakup is there, gross total income is there, chapter 6A is there, total income is there, answer over. Technically, now PGBP, he will go to the next page. Working note is there, no? You would have given working note, right? Then salaries income, then house property income, working note will be there, right? They will go to the working note and then see your answer. Now, computation of tax liability. Computation of tax liability. Generally, 15 marks total income question, no? They will also ask tax liability computation. Tax liability computation will have a weightage of approximately 3 to 4 marks. Many students think it is only 1 mark. No, it will have at least 3 to 4 marks depending upon the complexity involved. For example, special incomes, capital gains, lottery income is also involved. And total income is more than 1 crore or more than 50 lakhs. Suppose if surcharge is there and special incomes are involved. Agriculture income, if it is also involved, then tax computation will be having 4 to 5 marks weightage. Depending upon the complexity of the problem, depending upon the composition of the total income, tax liability computation weightage will vary. Are you clear? Now, still I'm only at introduction stage. So look at now. So first compute major head of income, then compute income for other heads. Then put it in the table which I showed right now. Then clubbing provisions you apply, set off and carry forward provisions you apply. When you are solving income under other heads, especially, yes or no, clubbing provisions also you should keep in mind. Then you will get gross total income. Once you completed gross total income, you will check for chapter 6 reductions, correct? Huh? You will check for chapter 6 reductions. Don't reduce it. Never. In the working note, no, or in your mind, in the gross total income, how much are normal incomes, how much are special incomes identified. Okay, so normal incomes means what? Special incomes means what? 111A, 112A, 112, 115BB, 115BBJ, all this lottery incomes, all these are all special incomes. For example, gross total income is, let us assume 15 lakhs. Okay, now special incomes are approximately 12 lakh. Then balancing figure will be 3 lakhs, which is actually called as normal income. And you know what? Chapter 6A deductions you will compute, right? Total of chapter 6A deduction shall not exceed 3 lakh. The total of chapter 6A deduction shall not exceed normal incomes, because special incomes are not eligible for chapter 6A. Long term capital gain 112A, normal long term capital gain 112, short term capital gain 111A, lottery income, all that, they are not eligible for deductions for chapter 6A. Therefore, even though 15 lakhs gross total income is there, for example, no, hypothetically chapter 6A total comes 4 lakhs, but you can claim deduction only 3 lakh. Very important. These are all for MCQs, especially at the time of MCQ solving. This is very, very important. Next. Okay, now again, when you are claiming chapter 6A deduction, remember the tax regime here. Why? Because chapter 6A deductions, in chapter 6A deductions, optional tax regime, you will get all deductions, whereas under default tax regime, you will get only deductions under 80CCD subsection 2, 80CCH subsection 2, 80JJAA. Only these 3 deductions you will get. 80CCD subsection 2, CCH subsection 2, JJAA. Only these 3 deductions you will get under default tax regime. You will not get these, only these 3 you will get. Remaining all other deductions under chapter 6A, you cannot claim in case of default tax regime. Suppose you are going with optional tax regime. Every chapter 6A deduction, 10AA exemption, 80C deduction, 80U deduction, everything, 80D, 80DD, 80DDB, 80JJAA, 80QQB, RRB, everything you can claim. I hope you are clear. Next. Now, then once you keep all these points in your mind, finally you will get total income. Like gross total income you computed, then reduce chapter 6A deductions where the total deduction value shall be less than or equal to normal incomes. Okay, if the paper has to be tough, they will test all these adjustments. You have to be very, very careful. I know you know all these points, but the point is, when you're writing an exam, if you don't have an approach like this, when you do not have any proper approach, you know, mostly what I see in many students is they learn concepts by solving more problems. No, of course that is a way concept will be built up, but only when they see a problem which they already solved, only that they will be able to solve. If a new question comes altogether, many of them not able to solve, only because they don't have this kind of clarity. I hope now you are getting a lot of clarity, yes or no? Then you will get total income. Fine, so total income is over. Okay, now see here, no, each head wise what are all the provisions were there, we need to discuss that. We will discuss you know, little while later. Now once you completed total income, the second part of the answer, 15 marks question, is computation of tax liability. You know what, I will tell you guys, straight away follow this format. Here there is a format which I gave, right? I developed this format, tax computation format. Straight away follow this format, don't deviate from this format. First, what you should compute when you're computing tax? Basic tax. First, what you should compute is basic tax. You know, again, when you're computing basic tax, you know, what are the checkpoints? When you're computing basic tax, what are the checkpoints? First, identify the tax regime. Once again, the moment you start computing tax, look at the tax regime. If it is optional tax regime, up to 3 lakhs exemption, 3 to 7, sorry, 2.5 lakh up to 2.5 lakh, 2.5 to 5, 5 to 10, beyond 10, you know, right? Yes or no? If it is optional tax regime, residents, you know, they will be classified into 3 categories: normal citizen, senior citizen, super senior citizen. Whereas non-residents, no, only 2.5 lakh basic exemption. Optional tax regime I'm talking about. That to tell me, tax rates will be varying based on the regime. Which incomes? Normal incomes. Normal incomes only the tax rate will be different. Okay, like normal incomes, the tax rate will be, you know, for normal incomes only the tax rate will be different. Under default tax regime and optional tax regime, the tax rates are different with respect to what? Only normal incomes. Special incomes are there, right? Long-term capital gain, 112A, short-term capital gain, 111A, lottery income, all that, 115BB, all that. No. For them, the tax rate is same. Whether it is optional tax regime or default tax regime, doesn't matter, the tax rate is same. So, first identify the regime. Then second thing you should check is, see whether agriculture income is there. I know it is exempted. In the given problem, agriculture income might be there. It might have been credited to P&L account. Agriculture income might have been credited to P&L account. When you are computing PGBP income, what you should do, you know, net profit you will start, right? In this net profit, agriculture income is already credited in P&L. That is considered in this net profit. But actually, is it taxable? No. So to arrive at PGBP income, what should I do with that agriculture? You will reduce it because it is not taxable. So you computed PGBP income, substituted that income in the total income computation, all that is fine. But when you are computing tax liability, if agriculture income is there, aggregation concept will apply. Basic tax cannot be computed straight away. You can't simply compute basic tax. Agriculture income also should be considered when you have agriculture income. Like, what is the, you know, we call it as aggregation concept, right? What do we call it as? Aggregation concept. You see, I'm giving you here, you know, there is a concept of aggregation. Tax calculation steps. What are the tax calculation steps if agriculture income is there? First, compute basic tax on total income, including net agriculture income. What do you mean by net agriculture income? For example, no, SSC is, no, he's growing mulberry leaves and then selling it. Mulberry leaves. Mulberry leaves is an agriculture produce. You know, he got totally 10 lakhs proceeds. But to grow this mulberry leaves, he spent 5 lakhs. Now, what is the net agriculture income? 5 lakhs. Only 5 lakhs will be added to, originally you computed total income, no, taxable income, total income. To that total income, add this 5 lakhs. Now you will get a revised total income. On that you compute basic tax. Okay, for example, no, my total income is 15 lakhs. Now agriculture income is 20, you know 5 lakhs. My total income is 20 lakhs now. This 20 lakhs now again split into 2 parts. How much are special incomes? How much are normal incomes? Special incomes 12 lakhs, sir. Normal income is balancing figure, which is 8 lakhs, sir. On special incomes, no, long-term capital gain 112. Apply depending upon the date of capital gain. If the capital gain is before 23rd July, 20%. If the capital gain is on or after 23rd July, 12.5%. Okay, now so like that apply special rates. Okay, whereas normal income law apply identify the regime, default tax or optional tax, where you are computing identify the regime, accordingly apply the tax rates, 0 to up to 2.5, 2.5 to 5, 5 to 10, beyond 10 if it is optional tax regime. In case of senior citizen 3 lakhs, in case of super senior citizen exemption is up to 5 lakh. Yes or no? Whereas default tax regime irrespective of senior citizen residential status, that and all doesn't matter. In an optional tax regime, 115 BAC is applicable for individuals whether they are resident or non-resident, doesn't matter. And the tax rates are constant up to 3 lakhs, 0, 3 to 7, 5%. Yes or no? 7 to 10, 10%, 10 to 12, 15%, 12 to 15, 20%, beyond 15 lakh, straight away 30%. There is no 25% slab rate, correct? There is no 25% slab rate in case of optional tax regime. You know, May 26 exam, May 26 I'm talking about, Finance Act 2025, 25% slab rate also has been brought. Fine, anyhow, for Jan 26 attempt, September 25 attempt, okay, this particular slab rate do not apply, don't worry. So, under default tax regime, these are the tax rates. I'm just showing you once again. Up to 3 lakhs, 0, 3 to 7, 5, 7 to 10, 10. Up to 12, 10 to 12, 15%, 12 to 15, 20%, and straight away after 15 it is 30%. Remember, these are applicable on normal incomes only, not on special incomes. Now, I told all the checkpoints here, yes or no? Now, look at the checkpoints once again. So, check the tax regime. You know, check for age, residential status in case of optional tax regime. Suppose if at all you are computing as per optional tax regime, if at all you are computing income as per optional tax regime, check for the age of the SSC and what is the residential status. Suppose if it's default tax regime, straight away calculate. So agriculture income point I considered and regime I considered. Now I will compute basic tax at first. First I will compute basic tax. When I am computing basic tax now, while calculating basic tax now, I will apply normal tax rates on normal incomes. Special incomes, I will apply special rates. And again, no, one more important point. For resident individuals, whether unexhausted basic exemption limit is applicable, check out. Sometimes what happens, you know, for example, suppose no, I am following default tax regime. Suppose in the exam, they gave a question of default tax regime. Total income is, for example, 15 lakh. Total income is how much more? 15 lakh. Now, within this 15 lakh, no, 3 lakhs is only, or else let us assume 2 lakhs is only normal incomes, 13 lakhs are special incomes. Now, normal income is 2 lakhs, right? Applicable basic exemption limit is 3 lakhs. Under default tax regime, basic exemption limit is applicable how much? 3 lakh. Now, 1 lakh basic exemption limit is free. No, that can be set off against. So, that 1 lakh is first called as unutilized basic exemption limit. This unutilized basic exemption limit can be set off against long-term capital gain 112 or 112A or short-term capital gain under 111A. So, to any of this you can set off this 1 lakh. You know what how I will set off, you know, for example, no, you know, here is where for September 25 and Jan 26 only the complication is there. May 25 attempt, September 25 attempt, Jan 26 attempt. For these 3 attempts, no, previous year is 24-25, assessment year is 24-26, especially if capital gains is there, date on which transfer happened is important to decide the tax rate. Suppose no, within this year, if at all transfer happened before 23rd July and transfer happened after 23rd July, long term capital gain 112, you know, if it is before 23rd July 20%, 112 ma, not 112A. If it is after 23rd July, then long term capital gain is 12.5. Same way, 112A before 23rd July the tax rate is 10%. Okay, after 23rd July the tax rate is 12.5%. Now 112A tax rate is there, right? 112A tax rate 10% if the capital gain is before 23rd July, if the shares are sold before 23rd July, if the shares are sold on or after 23rd July, on or after 23rd July, if at all you are selling the shares, then tax rate is 12.5%. Here, most important point, you know, right? Before 23rd July, the tax rate is 10%. On or after 23rd July, the tax rate is 12.5%. And you know very well that 1.25 lakh exemption is there. Suppose, by the way, remember 1.25 lakh, like 10% beyond 1.25 lakh, 12.5% beyond 1.25 lakh. This is what the provision, correct? Like, is it separate 1.25 lakh before 23rd July, separate 1.25 lakh after 23rd July? No, it's a combined limit in the entire year. Suppose no, 112A capital gain SSE got before 23rd July, before, I mean, okay, before 23rd July, SSE got, for example, 3 lakh, and after 23rd July, SSE got 2 lakhs. So total 112A capital gain is how much? 5 lakh. And we know very well this is taxable at 10%, this is taxable at 12.5%. Now we know very well total is 5 lakh, maximum exemption available is 1.25 lakh only. Throughout the year put together is 1.25 lakh only. Again here, this 1.25 lakh, no, where I should set off? Should I set off against, 10% income or 12.5% income? There is no provision in the law. They only say up to 1.25 lakh long-term capital gain under 112A is not taxable. They say there is no tax on that. Remember, they are not saying it is exempted. Don't confuse with exemption, exempted income concept. Under 112A, whatever long-term capital gain is there, up to 1.25 lakh basic exemption tax is 0. Beyond 1.25 lakh 10% or 12.5, whichever is applicable depending upon the date of transfer. That doesn't mean 1.25 lakh is exempted income. Be careful, it is not exempted, it is taxable. That entire long-term capital gain 112A will form part of gross total income, will form part of total income only at the time of tax computation. First 1.25 lakh I will not consider any tax. First 1.25 lakh I will not consider any tax amount. Beyond 1.25 lakh only I will consider. Now this 1.25 lakh I can set off either against 12.5% rate or 10. That is your choice. But I recommend, because tax rate is 12.5, 2.5% extra na. So I will set off here 1.25 lakh. 1.25 I'll set off. So balance amount is what? 75,000. Balance amount is 75, which is taxable at 12.5. This 3 lakhs I will tax at 10%, which is equal to 30,000. That's it. I hope I have given you clear explanation on 112A 1.25 lakh limit. Next, still once again, when we open basic concept chapter, when I'm revising there, I will connect all these dots. Okay. This 15 marks total income computation is the deciding one for income tax, especially whether you will be scoring or not. This 15 marks question will decide. If at all you understand until now, whatever I've covered until now, I'm telling you, trust me, you will really rock the paper. No matter how tough the paper, easy or tough. I personally do not discriminate whether paper is tough or easier. I only know, do I know the question or not? Do I know the answer or not? That's it. If you don't know the answer, many questions, if you don't know the answer, you call it as tough. If many questions you know the answer, you call it as easy. Means here, it's not the paper which is tough or easy. It's whether you know it or not decides tough or easy. That's it. Now, again, so when you're computing basic tax, unexhausted basic exemption limit point I told, 112A 1.25 lakh point also I told. Now, next one, check for long-term capital gain. See, in the question, in the given question, total income question, or maybe a separate capital gain question, or maybe MCQ question. Suppose there is a long-term capital gain. For example, there is a long-term capital gain on what? On residential immovable property. Residential immovable property is there, which is sold by individual or HUF. Who sold it? Individual or HUF sold it. Residential immovable property. But when that was acquired, it is acquired before 23rd July. It is acquired before 23rd July. The house, these people acquired long back. And the house is sold on or after 23rd July. For these people, in previous year 24-25, any long-term capital gain, no indexation at all. I hope you are aware of indexation point. I hope you are aware of indexation point, right? Long-term, if a capital asset is a long-term asset, indexation facilities available, non-depreciable assets I'm talking about. Section 48 computation format of capital gains. As per section 48 computation format of capital gains, long-term assets are eligible for indexation. But if at all you are selling during the year, that too you are selling when? After 23rd July. No indexation at all. No indexation. See, if at all you are selling on or after 1st April, but before 23rd July, as usual, full value of consideration minus transfer expenses, then you will get net consideration minus indexed cost of acquisition, indexed cost of input. Happily you can take. But if the transfer date is after 23rd July, that too what you transferred is immovable property. When you are computing capital gain, no indexation. But when you are computing tax liability, and property was purchased before 23rd July, and sold after 23rd July 2024, and it's a long-term asset. Indexation we did not claim at the time of computation of capital gains. We did not claim indexation, but at the time of tax computation, you once again compute long-term capital gain. Rough notes in tax computation. Once again you compute. At the time of tax computation, once again you compute long-term capital gain with indexation after exemption. Then balance amount applied tax rate. Okay, 20% with indexation tax rate, 12.5% without indexation. Yeah, I will try to solve a problem also if possible. Don't worry. Okay, I will solve it. So don't worry. So 12.5% without indexation, 20% with indexation. Try to apply that. Okay. Now then you will get some tax, lower tax, 20% tax rate, and what is the tax liability? 12.5% without indexation on that. How much is the tax? Between these two, whichever tax is low, that tax you will take into basic tax. This is one more major checkpoint when you are computing basic tax, because this is important for MCQ. In the recent exam, May 25 exam or May 25 exam, this question was asked. In the May 25 MCQ exam, this question was asked. Long-term capital gain on residential immovable property beneficial scheme they asked. And remember, for 112A capital gain, no rebate at all. For 112A capital gain, no rebate at all. Then follow the steps as per above tax computation format to arrive gross tax limit. Now, until now what we computed, only basic tax. Only basic tax we computed. So once you compute basic tax, put number here, basic tax. Then add surcharge. Surcharge at what rate? I'll show you. Don't worry. Surcharge at what rate? It depends upon the regime again. Surcharge is influenced by regime. By the way, before I go into surcharge, let us look at the rates, tax rates. Special income 112, long-term capital gain. What is the tax rate? If at all the capital asset is transferred before 23rd July, straight away you will get 20% is the tax rate for long-term capital gain, where indexation, if applicable, you can claim indexation benefit. You can claim indexation benefit while computing capital gains. Suppose if the transfer is on or after, 23rd July, that to what you transferred, land, building, or both. Who transferred? Resident, individual, or HUF transferred, which is acquired by them long back. Sold on or after 23rd July, but acquired by them long back. Then tax rate, I'm talking about tax liability. I'm not talking about capital gain computation. Capital gain computation is always, see, transfer date after 23rd July. Yeah. Transfer date on or after 23rd July. Yeah. No indexation at all. It's a long term or short term, doesn't matter. No indexation at all. Now, lower of 20% tax rate with indexation, 12.5% tax rate with indexation. So, compute wherever the basic tax is low, that tax will be final, added to the remaining basic tax, and then rest of the format will apply. Okay. Then this is regarding unlisted shares by non-resident. That is not relevant for you. 112A. Suppose you are having long-term capital gain on equity shares, equity-oriented funds, or business trust. Okay, long-term capital gain. I already told 112A, STT is paid. If the transfer is before 23rd July, straight away the tax rate is 10%. If the transfer is on or after 23rd July, the tax rate is 12.5%. In both the cases, no, up to 1.25 lakh, no tax. And this 1.25 lakh is full year limit. In entire year, up to 1.25 lakh only, no tax. Okay. And that too, beneficial treatment. Which 1.25 lakh I can claim exemption, sir? Whether I can claim exemption where 10% income or 12.5%, you can claim exemption on 12.5% portion. Then short-term capital gain 111A, same, equity shares, equity oriented fund, business trust, where STT is paid. If the transfer is before 23rd July, earlier it was a lower tax rate, 15% only, but now the tax rate is higher. If the transfer is on or after 23rd July 2024, the tax rate is 20%. Remember, for September 25, Jan 26, and even already we completed May 25 attempt. Okay, in all these three cases, the previous year will be 24-25, assessment year will be 25-26. Previous year 24-25 means what? The problems will be based on information given from 1st April 2024 to 31st March 2025. That's it. And 115BB winnings, flat 30% tax rate. 115BBJ online winnings, net winning is straight away taxable at 30%, and unexplained income, black money discovered, 60% tax rate. That too, for black money, no, when you're taxing it, separate surcharge rate of 25% is applicable. Separate surcharge rate. So effectively the black money is taxed at 78%. That's it. Now surcharge, like as I already told, no, once you arrive basic tax, Then you need to add what? Surcharge. When you're again adding surcharge, identify is default tax regime or optional tax regime. Identify once again in the given question, default or optional, identify. Now when you're adding surcharge, see what is the total income, including everything, including every income. If the total income is just between 50 lakh to 1 crore, if it is between 50 lakh to 1 crore, 50 lakh crossed, less than or equal to 1 crore, surcharge rate is 10%, whether default tax or optional tax doesn't matter. Surcharge rate is how much? 10%. Suppose if the total income is between 1 to 2 crore, total income is between 1 to 2, including everything, then the tax rate is 15, surcharge rate is 15. Sometimes suppose total income you computed, it is more than 2 crore. Then automatically these two options closed. Immediately you will come to third option, fourth option, fifth option. Now total income you have, from that remove dividend, remove capital gains. Okay, 111A, 112, 112A. Some students here they accidentally removing lottery income, all that. No need. Only dividend, capital gains under 111A, 112, 112A. Only capital gains income, dividend income. Only this. Exclude that. Now how much is the total income? If the total income is more than 2 crore but not exceeding 5 crore, if the total income is more than 2 but not exceeding 5, then 25%. Sir, total income is crossing 5 crore, sir. But under default tax regime, the maximum surcharge rate is 25. But if it is optional tax regime and total income is more than 5 crore, 37% surcharge. 37% the surcharges. And sometimes total income is more than 2 crore. But if I exclude a dividend, total income, including dividend, everything is more than 2 crore. Okay, since it is more than including dividend, everything more than 2 crore, that is not coming here. Okay, I will exclude dividend and capital gains. Again, it is not coming under 3 and 4. My situation is total income including dividend, including capital gains will not come under, is not coming under 1, 2, 3, 4. Then fifth provision will apply. As per the fifth provision, the surcharge rate is 15. Remember, most important, rate of surcharge shall not exceed 15% in respect of tax on dividend, tax on capital gains. When you compute tax on capital gains, on that the surcharge rate can be maximum 15%. Further, all other incomes, normal incomes, everything, on that you will have computed some basic tax, it may be lottery income, it may be other casual income, they're all taxed by 10, 15, 25, 37 as the case may be. Simply, the surcharge rate on dividend and capital gains cannot exceed 15%. So like how you should compute this, very simple. For example, my SSC total income is, let us assume 3 crore. SSC total income is, let us assume 3 crore. Look at carefully how I'm solving this. Okay. Now in this, dividend income is, let us assume 20 lakh. Long-term capital gain 112 is, let us assume 20 lakh. Long-term capital gain 112A is, let us assume, let me write more clear, 20 lakh, 3 lakh. This is, let us assume, okay, fine, 10 lakh. And short-term capital gain 111A, short-term capital gain 111A, that is also, let us assume 10 lakh. And there is some special income, lottery income is also there. Lottery income is also there, which is 10 lakh. Then what is the balancing figure? What is the balancing figure? So just identify this. What is the balancing figure here? So 10, 30, 50, 50 plus 10, 60, 70. Out of 3 crore, 70 lakhs or special incomes remove. Then balancing figure is 2 crore 30 lakh. Yes or no? 2.3 crore. Now here, lottery plus these two has to be considered, which is 2.4 crore. Total income excluding dividend, excluding long-term, all this is 2.4, which is more than 2 but not exceeding 5. So then automatically on this first you compute basic tax. How you should compute basic tax? On 2.3 crore, no. On 2.3 crore, no. At slab rates you compute basic tax. On 10 lakh, no. 30% you compute basic tax. Okay, you will get basic tax. On this you will have surcharge at 25% or 37% as the case may be. Since it is more than 2 but not exceeding 5, surcharge rate is right away. Surcharge rate is right away, 25%. Now, when you're computing, suppose here dividend is there, long-term capital gain, short-term capital gain, everything is there. Now dividend is also normal income only. Now when you're computing first normal basic tax, you already computed basic tax, no? So in that, how much is dividend related tax? How to compute the dividend related tax, So here dividend is 20 lakh divided by total normal income. Total normal income is 2.5 crore. Total normal income is 2.5 crore. And normal incomes, total on 2.5 crore normal income, how much is the normal rates of tax? Apply. So you got some tax amount. Dividend income is this much. This is the total tax on total normal income. You will get dividend related tax portion. Why you need to compute dividend related tax portion? Because no, here 15% only surcharge will apply. Whereas here, by the way, this related logic I think I already covered in my marathon. The original marathon is there, right? My 12 to 15 hours marathon is there, right? There I already covered. That's it. Yeah, I'm speeding up, ma. I'm speeding up. Okay, that's it. Some students are feeling that September 25 law paper was very tough. What if I lose? Generally, when the paper is extreme tough, paper valuation will be little liberal. So even if you think you won't get 40, sometimes you may see in the paper, in the question paper, 50 plus marks you will see in the result card. So don't lose hope. Be serious on tax. Trust me. Okay, if at all you have given at least 60 to 70 marks, if at all you at least attempted 60 to 70 marks, and the paper is extreme tough, there are high chances you will score 45 plus 50 plus for sure. Don't worry at all. Okay, fine. Next. So that's about surcharge. Once you computed surcharge, then what you will get is this subtotal. From this, rebate is applicable. When rebate is applicable, we already know. When total income is not exceeding 5 lakh, rebate is applicable. If it is optional tax regime. If it is default tax regime, when total income does not exceed 7 lakhs, then also rebate is applicable. Now I'm not going into rebate calculation, all that. I hope you already know it. If at all you want to know rebate calculation, how it works, all that, please go to my main marathon. There I have already clearly explained. So then rebate, then marginal relief. Marginal relief, how to compute marginal relief? My main marathon is that there you can listen to it. So marginal relief also you compute. Then what you will get is called as subtotal. For that, add 4% education says what you will get is called as gross tax liability. What is this called as? Gross tax liability. Once you computed gross tax liability, be careful. The gross tax liability you computed, right? Answer is not over yet. Most important, the AMT applicability. If at all optional tax regime is there, AMT is applicable. That too, when AMT is applicable. If the SSE has claimed 35 AD exemption, deduction, 10 AA deduction, 80 QQB, RRB, JJAA. Yes or no? The SSE who claimed 10 AA, 35 AD, 80 QQB, RRB, JJAA. If these deductions are claimed by the SSE, then AMT provisions are applicable. Be careful. That too, if at all you are computing income under optional tax regime. Suppose if the total income problem is straight away default tax regime, then AMT question itself will not come. Suppose if the problem is optional tax regime, then AMT question will come. Sometimes, if the paper has to be very tough, examiner want to make very tough paper, they will ask you to compute income as per both the regimes. Wow, that will be even more tough. Both the regimes they will ask. When both the regimes are tested, first you compute gross total income as per DTR. Then do little adjustments to arrive OTR income. Then compute again tax. When you are computing tax under optional tax regime, compute as per whatever we discussed. Plus see AMT applicability. In the question, 35 AD deduction is there. 10 AA deduction is there. 80 QQB, RRB, JJAA deduction is there. Add back all these deductions to the total income. Under optional tax regime, you compute total income, right? Add back all these deductions. Minus notional depreciation. What is it? Notional depreciation. Because 35 AD deduction you don't get, right? Yes or no? When you're claiming, in AMT, 35 AD deduction we will not consider. So on the capital expenditure, 35 AD deduction we are adding back. So we are not claiming any 35 AD deduction on a capital expenditure. On that, when you're not claiming 35 AD deduction, you can automatically claim depreciation. So notional depreciation, reduce it. Then what you will get is called as adjusted total income. And if that adjusted total income is not exceeding 20 lakh, if that adjusted total income is not exceeding 20 lakh, AMT provisions will not apply. If the adjusted total income is crossing 20 lakh, then AMT tax will attract. Then accordingly, don't worry, AMT related provision also I have clearly given. Very easily I have given. Look at this. Okay. I'm about to finish this total income topic. I'm about to finish this, and immediately after that I'll go to salaries chapter discussion. No. Residential status chapter discussion I'll do, or salaries chapter discussion I'll do. Okay. Now look at, if a person is claiming deduction under 80 JJAA QQB RRB income based deductions or 10AA 35AD, then automatically AMT will apply. Again, AMT tax you don't have to compute if the SSC adjusted total income does not exceed 20 lakh. What is adjusted total income? First identify tax as per normal regular provisions. Add back deductions under 10AA, add back deductions under 35AD, less depreciation under that less depreciation in respect of the capital expenditure, whatever 35 deduction you claim, no deduction you're adding back, no. So on that notional depreciation you reduce, then add deductions claimed under 80 JJAA QQB RRB, then what you get is adjusted. If this particular income is not exceeding 20 lakh, no AMT. Suppose if it is exceeding 20 lakh, straight away the tax rate is 18.5% straight away. Sir, this income has special incomes like lottery, everything is also there, sir, because no normal incomes, no, that include lottery. So automatically 80 also include lottery, long-term capital gain, short-term capital gain. For AMT provision, what income is there doesn't matter. On entire income, 18.5% tax rate apply. That's why I gave you special incomes, if any, ignore. In the sense, no, ignore the logic of special rates of tax. Special rates of tax, ignore. So, and on adjusted total income, straight away 18.5%. So 18.5% plus surcharge. Surcharge at what rate? If adjusted total income is more than 50 lakh, then surcharge rate is 10%. If the adjusted total income is more than 1 crore, then surcharge rate is 15%. If adjusted total income is more than 2 crore, then surcharge rate is 25%. Straight away. Are you clear? Next. That's it. So that is regarding AMT. AMT credit, all that I'm not discussing here. If you want to have an idea on AMT credit, all that, in the description I gave a Google Drive link. No, inside that, what are the resources to be followed. By to that extent, this particular video is there as part of a playlist. Go to my YouTube channel, caramharsha. Day before exam taxation playlist is a September 25. Inside that, my marathons are already there. Inside that, part 2 marathon is the TDS, TCS, AMT. So inside that, you go and see AMT related detailed discussion I gave. That's it. Okay, so now such a complicated, no. So then AMT check, you should do AMT check if it is optional tax regime. Okay, most important, check once again AMT applicability, compute AMT on adjusted total income 18.5%. If AMT is higher than regular gross tax liability, then gross tax liability will be nothing but AMT liability. Whatever AMT that you are paying beyond regular tax, no, that is called as AMT credit, which will be carried forward after 15 years. Now finally arrive the tax payable amount. How to arrive tax payable amount? Right now you decided gross tax liability. Suppose if AMT liability is less than regular tax, then regular tax is gross tax. If AMT liability is more than regular tax, then AMT will be the gross tax. From this, no, reduce TDS, TCS, advance tax, everything, then you will get tax payable amount. That's it. This entire total income, what are the points, what are the checkpoints that are involved, everything I have covered. Now each head of income we need to discuss. Okay, now before I proceed with heads of income, in the basic concepts, I want to discuss certain concepts. For example, I want to discuss about agriculture income concept. Every attempt agriculture income, some question they're asking. Every attempt they're asking. I have seen in September 24, Jan 25, May 25, agriculture income question pakka they're asking. Okay, that's it. Now look at. So agriculture income, what are agriculture incomes? You know, if at all any rent or revenue that is you are getting from the land, that is agriculture income. Or you are using that land for agriculture activities and getting income, that is agriculture income. Or there is a farm building. Okay, there is a farm building, that is also agriculture income. Okay, now all the three are agriculture income. Sometimes, no, suppose no, SSC is directly doing agriculture activity. Suppose SSC is doing directly agriculture activity. He's producing some agriculture produce, and he is also doing business activity. The same some of the agriculture produce, no, he's using it for own business. Okay, suppose no, if the SSC is no, he's growing rubber products. Rubber he is growing, and he is selling the rubber. Okay, rubber plants, rubber related plants grown within India. Then whatever total income is there, right, 65% is straight away treated as agriculture income and 35% is treated as business income, means 35% only taxable. Coffee grown and cured, only curing stage. Roasting, grounding is not there. Then if roasting, grounding is not there, only up to curing stage, you know, business income is 25, predominantly agriculture only. Suppose you are doing roasting everything, commercial activity increased. Commercial activity increase means business income taxable portion will be 40% and non-taxable portion agriculture income will be 60%. And tea grown and manufactured 60 and 40. Now many students know, if at all this question is given, they'll compute like this, everything superb. Total income and all they'll compute correctly. But when they're computing tax, no, they forget to consider the 65, 75, 60, some number, some amount they will get, right? They will forget to consider that. They will forget to consider. Okay, when you're computing tax liability, not only on the business income you should compute tax. When you're computing basic tax, aggregation concept will apply. Since agriculture income is involved, aggregation concept will apply. Be careful. Then sometimes, no sir, I'm not selling rubber, all no, not this sir, I'm selling some other product sir, mulberry leaves I'm making growing sir, I'm growing some cotton sir, or I'm going sugar cane sir, so some other product I'm producing, and I'm doing some further process also. Okay, I'm doing some industrial process, then I'm selling it. Now how to compute agriculture income here? Very simple. If the produce, no, like for example, no, income from growing and manufacturing, you are growing and manufacturing, market value of agriculture produce which is used as raw material will be deducted from total income. When you are computing business income, market value will be reduced. Look at, for example, no, I produced sugarcane worth of 10 lakhs, and or else, no, I'll do one thing, just 1 minute, I'll just open some or else it's okay, fine, I think that directly we can produce, we can go with it. Okay, 10 lakhs is the sugarcane growing cost. 1 minute, I think I'll do one thing here, I'll do better one thing. Jan 25, not Jan 25, May 2025 paper analysis is there. May 25 or Jan 25 paper analysis I gave, paper analysis, where inside that agriculture computation, agriculture income computation is there. Further processing, manufacturing activity, that and all involved, that question is there. Just directly watch that will be more beneficial. Or go to the revision class. There is a revision class which I have now in the same playlist, day before exam playlist. Part 1 revision is there, right? Inside that agriculture timestamp is there. Inside that one problem I have solved. Kindly go and watch that. Okay, this session, no, my objective in this session is where and all confusion points whether I want to break that. So let me not waste time on each and everything in depth. Okay, I hope I'm giving you all checkpoints. All the checkpoints I'm giving you, I hope you're able to understand that. Very simple. If agriculture produce is used for further manufacturing, now 10 lakhs is the fair market value of the agriculture produced. This will be treated as raw material cost. Now you did further manufacturing, no, and you sold it for some amount, sale proceeds. From that sale proceeds, no, reduce the market value of the agriculture produce, reduce manufacturing expenses, all that, then what you will get is called as business income. Now whatever 10 lakhs worth of material you used, no, in the manufacturing, that is treated as agriculture income, because you didn't sell, you used it. That is also treated as deemed sale, and that is treated as agriculture income. Whatever the agricultural produce you used in manufacturing, no, market value will be shown as business expenditure. When you are calculating PGBP income, that market value which is shown as expenditure, the same is considered as income here, agriculture income. Now aggregation will apply accordingly here, so be careful. Okay, that's it. See, I hope you already solved all these problems earlier. That's what I assume. If I sit and do the problem, you may understand that problem alone, but in exam that problem will not come. A new question will come for sure. So that's why the concept is most important. I hope here you're able to reconnect. Yes or no? Next. So with that agriculture income discussion is over, where I specifically spoke about composite activity, where agriculture and commercial activity both are involved. Rubber we discussed, coffee we discussed, tea we discussed. Next, apart from that, what else we have? Rebate we already understood. And tell me, what is the maximum rebate available? What is the maximum rebate available? In case of optional tax regime, maximum rebate is 25,000. No, 12,500. Maximum rebate is how much? 12,500 in case of optional tax regime, whereas in case of default tax regime, maximum rebate is 25,000. Correct? Look at, so rebate, so under optional tax regime, here it is there, under optional tax regime, maximum rebate is 12,500. Actual basic tax or 12, whichever is lower, that much. Okay, now here rebate can be reduced from special income tax as well as normal income tax, doesn't matter, no differentiation. Even here in default tax regime also, up to 25,000 rebate is there. Now in default tax regime, if the total income is not exceeding 7 lakh, identify what is the basic tax, or 25, whichever is lower, that much you reduce it. Okay, if the total income is more than 7 lakh, marginal rebate, what do we call this as? Marginal rebate is available. Marginal rebate is how much? First step A, total income, sir, 7 lakh 10,000 sir, minus 7 lakh sir, so 10,000 step A. Step B, 7 lakh 10,000 on this, no, identify tax at normal rates, in the sense, no, on 7,10,000 whatever income tax total income is there, on that calculate normal tax. Suppose this comes 12,500, then rebate will be 2,500. If B is more than A, then the rebate will be 2,500. That's it. Okay, this is like a marginal relief similar logic. And integration of agriculture income, everything is completed. That's it. Residential basic concepts and the total income approach to total income is completed. Those of you who understood this approach to total income, 99.99%, you will not do any of those, you will not miss any of those checkpoints, especially gross total income, chapter 6 checkpoint, tax regime checkpoint, and basic tax computation checkpoints, surcharge checkpoints, every checkpoint I covered. Clear? Residential status, straight away, individual. First I will straight away discuss with individual residential status. See, in a simplest way I'll tell you something that you have never understood residential status like this. Okay, individual, first we should check basic residential status, correct? Then we will check additional residential status. Actually individuals are categorized into resident and ordinary resident, resident and not ordinarily resident, and non-resident. These are the three ways in which individuals are classified, correct? First we should check resident, then we should check ordinarily residential status, then we should check ordinarily residential status. So first we should check resident or not. To check this resident, there are three categories. There are three ways a person can become a resident. Individual can become a resident in three ways. What are the three ways? Look at here. First one, basic conditions. There are two basic conditions given. If any one basic condition is satisfied, he will be a resident. What is that? Individual, no, he stayed in India for 182 days or more during the relevant year, then he is a resident. Individual has stayed in India for a period of 60 days or more and 365 or more in the past 4 years. If any of these conditions are satisfied, he is automatically a resident. Don't worry, ma. Hardly this is a 10 to 15 minutes topic. Resident status. Immediately I'll go for salaries. Okay, that's it. Somebody is asking regarding earns rental income from country X which has DTA agreement. DTA we don't have in syllabus, Devesh, so don't think over unnecessarily. Okay, fine. We don't have double taxation avoidance agreement, all that, so don't worry, ignore it. We don't have it in syllabus at all. Next. So individual, no, he stayed 180 days in India in the current year. Resident, straight away, no questions asked, resident. Category 1 base. As per category 1 you are resident. You don't have to check category 2. You don't have to check category 2 deemed resident, category 3. So first basic conditions based residential status we should apply. Basic conditions not satisfied. Then category 2 special residential status we should check. That is also not satisfied. Then deemed residential status we should check. If all the three categories does not satisfy, he is a non-resident. Some students, what they do, they will check B1 and B2. If both are not satisfied, they will straight away call him as non-resident. Wrong. Here special residential status 120 days, 4 years, 15 lakhs logic, that and all there. Be careful, that and all is there. That too, when you are computing 15 lakhs logic, no, there is a big crux involved. I will tell you, I will show you now. So any of these two satisfied, automatically is a resident. You know what? This 60 days or more, 365 days or more logic is there, right? This is very, very easily compliable. Anybody can comply with the 60 days logic. So that's why what they did, those who are leaving India, citizens who are leaving India, that too for employment purpose. Suppose an Indian citizen individual is there, he is marrying somebody else abroad and then leaving. That's not for employment. This exception will not apply. So leaving for employment, an Indian citizen leaving India for employment, or Indian citizen working as a crew member of Indian ship, or Indian citizen, person of Indian origin, settled abroad already, but he is visiting India just as a visitor here. These three people, B2 condition we will not check. B2 condition 60 days or more, 365 days or more in the last 4 years, that point we will not check. These people will be resident only if they are staying in India 182 days or more. In the relevant year, 24, 25, 182 days stayed or not? No, straight away. There is another checkpoint I told you. If B1, B2 both are not satisfied or B2 is not applicable, you can't straight away apply, you can't straight away say non-resident. Category 1 we checked now. Category 2 we will go and check. Category 2. What is category 2? Category 2, inside this category 2 you see. Category 2 means what? Suppose he is an Indian citizen or a person of Indian origin. Either Indian citizen or person of Indian origin. They are visiting India. For them, no, visitors. Indian citizen visiting India. Origin, person of Indian origin visiting India. How to decide residential status? 1. Have they stayed in India 182 days or more in the relevant year? Yes, sir. Stayed a resident. Sir, no, sir. They didn't stay, sir. Then check this. Have they stayed for at least 120 days? Yes, sir. In the last 4 years, have they stayed for 365 days or more? Yes, they stayed. And income from total income other than foreign sources income is exceeding 15 lakhs. If that is the case, suppose no Indian citizen, sir, Indian origin, sir, he stayed only for 120 days or more, and last 4 years 365 days or more. Okay, and he has 15 lakhs plus income exceeding 15 lakh. Indian sources income is more than 15 lakh. Foreign source income, excluding foreign source, Indian source income is more than 15 lakh. If these conditions are satisfied, then that person will become a resident. Suppose no, sir, 120 days logic did not satisfy, sir, or Indian source income is less than 15 lakhs, sir. He is there for more than 120 days, 365 or more is there, but income is less than 15 lakh. Then he is a non-resident. You can't straight away say non-resident. You should apply third category. Is he also deemed resident or not? You should check. You should check deemed residential status point. Is he Indian citizen? Yes, sir. Is an Indian citizen. He is visiting or not visiting, or leave it. Sir, is an Indian citizen. He has income where excluding foreign sources, Indian source income is more than 50 lakh, and he is not liable for tax in any other country. Then he is straight away deemed to be a resident. Deemed resident and a special resident, they are always RNOR. Deemed resident and special residents are always RNOR. Understood? Now here there is a checkpoint. There is one RTP MTP questions were there. Past exam question is also there. Suppose I'm checking residential status. We have something called scope of total income. Remember, like as per that, income accrue in India, it's an Indian income. Income received in India is an Indian income. Okay, actually here only accrual. Income accrued in India, it's an Indian income. Business or profession outside, control is from India. That is also treated as source in India for the purpose of checking 15 lakhs limit. For the purpose of checking 15 lakhs limit, if the business is outside India, profession is outside, but it is controlled from India, set up from India, that is also treated as source in India. That income is also the source in India for the purpose of checking 15 lakhs. Yeah, I considered that also. Still my income is less than 15 lakh. Then he is straight away called as non-resident. Once he is a non-resident, if any income source is in India, that is only taxable. Receipt in India, that is only taxable. Sir, business outside, profession outside, control from India. No. Remember that. But for checking 15 lakhs limit, even though the business is outside, profession is outside, control from India, set up from India, that is treated as Indian source. For the purpose of checking 15 lakhs, that is Indian source. At the time of taxability, we should apply section 5 logic only. Scope of total income. As per scope of total income, what incomes are taxable? For our work, global income is taxable. For non-resident, only source in India, taxable. Receipt in India, taxable. For RNOR, source in India, taxable. Receipt in India, taxable. Sir, business is outside, sir. Profession is outside, sir. Okay, but it is controlled from India. Profession set up from India. Then also it is taxable. This point I once again clearly explained in a detailed marathon. I hope you can see the detailed marathon also if you want to look at. There also I clearly explain. That's it. So that's it. In residential status, the crux point I told. Now you know, like conclusion. Residential status, I'm concluding. Okay, I'm not discussing much in depth in the residential status. You can watch my other revision where a revision marathon is there, right? My 12 hours 14 hours revision marathon is already there in the playlist. Okay, there you can watch. Okay, here I'm only trying to identify all the exceptional topics where you will do mistakes. Okay, so residential status for individual, how to check? 182 days logic is satisfied. Straight away go to additional conditions. Sir, he is not resident through 182 days logic. He is a resident through 60 days logic. Then also go to additional conditions. A1, A2, 730 days, 2 years out of last 10 years. That logic. Sir, he is becoming a resident through 120 days logic, 15 lakhs income logic. He is RNOR. Sir, he is a deemed resident. He is RNOR. That's the conclusion. Okay, next. That's it. With this, residential status is also completed. Now let's revise income from salaries. Don't worry guys, after 1 hour I will give a break. Maybe salaries I will try to finish, and house property also I'll try to finish. Then we will take some half an hour to 45 minutes break, and then immediately we'll continue the live. Okay, up to night 11:30 12 will continue. That's it. Just 2 minutes. Let me take 2 minutes breathe. Okay. We'll continue. Yeah. Yes, we'll continue. So income from salaries. So how should we compute income from salaries? First you will have to compute gross salary, then you will have to reduce deductions, then automatically what you get is income from salary. Now in salaries, we have various types of incomes. What are the incomes? Broadly in salaries, we get totally two types: monetary, non-monetary. Within monetary, again two types: allowance based and reimbursements. Monetary you have two types: allowance based, reimbursement. Reimbursements are called as perquisites. Reimbursements are called as what? Perquisites. Non-monetary are also called as what? Perquisites, like RFA, motor car, all that. Allowances means what? Basic salary is an allowance, HRA is an allowance, leave encashment, during employment, during, not at the time of retirement, during employment is also treated as allowance. Okay, uniform allowance, helper allowance, like that, so many allowances. These allowances, under salary side of income, the allowances are broadly divided into two types. What are the allowances? Daily allowance, sorry. Allowances are again two types: personal allowance, official allowances. Now look at here. Suppose official allowance. Official allowance is again divided into two types. What are official allowances? Helper allowance, research allowance, uniform allowance. That is one category. Again, official allowance is second category. Traveling allowance, daily allowance, conveyance. Traveling, daily allowance, conveyance. No, these are all given for employee performing official duties. On duty, they are getting that allowance. So they are exempted under both the regimes. Under both regimes, they are exempted. How much exempted? Whatever they spent. To the extent spent is exempted. Suppose company gave me conveyance allowance of for example, every month 10,000 they gave me. Full year 1,20,000. I spent entire 1,20,000. Zero taxable. Suppose company gave me helper allowance for my official work. Research related allowance they gave me. Uniform allowance they gave me. Whether I spent or not doesn't matter. Even though their official purpose doesn't matter. They are fully taxable. Under default tax regime, they are fully taxable. Whereas in optional tax regime, to the extent spent it is exempted. Under optional tax regime, to the extent spent it is exempted. Which allowance? Helper, research, uniform. Under optional tax regime, to the extent they spent, exempt. Whereas traveling, daily conveyance is exempt under both regimes. Then these are official allowances. What about personal allowances? Personal allowances are straight away taxable. They are always straight away fully taxable. However, HRA, house rent allowance, exemption is there if it is optional tax regime. Correct? Children education allowance, 100 rupees per month per child. Exemption is there under optional tax regime. Children hostel allowance. 300 per month per child exempted. So maximum education allowance, hostel allowance, maximum 2 children. Tribal area allowance, 200 per month exempted. Default tax regime. Any personal allowance you are getting under default tax regime, no deduction at all. However, there is one personal allowance, transport allowance. Look at the word. Travel allowance is different. Transport allowance is different. Conveyance allowance, traveling allowance, I'll tell you. Conveyance allowance means what? Within the city, for official purpose, companies, employees traveling. For official purpose, marketing executive is traveling from meeting various customers within the city. That's called conveyance allowance. Marketing executive is traveling to another city and then incurring travel expenditure. That is travel allowance. Transport allowance means what? Employee coming to and from house to office, office to house. That allowance, for that purpose, if at all we give any allowance, that is called transport allowance. Transport allowance is exempted how much? Up to 3,200 per month is exempted under both the regimes. That too, the employee is blind, deaf, dumb, handicap. Only for them it is exempted. Okay, if an employee is blind, deaf, dumb, handicap and they are getting transport allowance, up to 3,200 per month is exempted under both the regimes. That's it. So this is regarding allowances. I hope now you are clear on allowances part, right? Now let's discuss about few more important topics in salaries. Pension. Pension is two types: uncomputed pension and computed. You see, uncomputed, I will treat it as allowance. For RFA salary purpose, in rent-free accommodation, salary definition is there, right? As per that, for that salary computation, for the purpose of RFA computation, no, uncomputed pension is also treated as, allowance. Fine, don't worry. When I'm discussing RFA, that there I will tell you, there is a concept called relevant period. For example, employees getting April, May, June. These 3 months, employees getting rent-free accommodation. For these 3 months only, salary components we should take. Suppose employee is getting uncomputed pension from December month, whereas he is getting rent-free accommodation from April to November only. Uncomputed pension will not be considered because April to November he didn't get pension. Suppose if at all employee is getting uncomputed pension during service, then that will be considered as part of salary for RFA purpose because it is treated as allowance. Okay, now allowance pension is of two types: uncomputed and commuted. Like what is uncomputed and commuted? Okay, generally pension is given at the time of retirement. I'll directly open the salaries topic better for easier understanding. Okay, there itself I will put some numbers and then show you how it works exactly. Allowances, entire this topic I told, entire this topic I told. HRA, how much is exempted, I did not tell, because here the entire main revision purpose is to give you clarity, to connect every dot, okay. But anyhow, briefly I'll cover HRA. How much is exempted? HRA, how much is exempted? That to remember, this exemption is only under optional tax regime. Okay, by the way, sir, under salaries, no, there are so many where optional tax regime, default tax, so much confusion is there. Summary I gave you. In the 6 pages PDF which I am giving, summary I gave. Summary of deductions not allowed under default tax regime for salaries chapter. Under salaries chapter, these deductions you will not get under default tax regime. What are they? Helper elements, fully taxable. Uniform elements, fully taxable under DTR. Research elements, even though these three are official purpose, they are fully taxable. Allowances received by judges, pension paid by UNO, they are all fully taxable under default tax regime. Rent-free official residence, whatever they are getting, judges, fully taxable. Generally it is exempt under optional tax regime, but under default tax regime, accommodation they are getting is fully taxable. Leave travel concession, fully taxable under default tax regime. HRA, fully taxable under default tax regime. Special allowances for personal purpose, fully taxable. No 100 rupees reduction, no 300 rupees reduction, nothing. Transport allowance for differently abled persons, no, 3,200 is exempted, except, that's why I put except. Then entertainment allowance provision tax, no deductions at all for that. Exemption for free food, right, food and beverages, non-alcoholic beverages and food, if at all a company is providing up to 50 rupees is exempt. That is not there in default tax regime. So under salaries chapter, what are all deductions that are not there under default tax regime, I clearly told. In optional tax regime, these restrictions will not be there. That's it. In optional tax regime, these restrictions will not be there. That's it. Now again, now I'll go back. So HRA, how much is exempted? Exemption, no, cannot exceed amount received, first criteria. Second criteria, rent paid, how much identify, minus 10% of salary you reduce. Okay, then you will get some number. Okay, then 50% of salary, third criteria. If at all the accommodation, if at all the rent is paid in Delhi, Kolkata, Mumbai, Chennai. Suppose if it is in other cities, third criteria is 40% of salary. Sir, salary means what, sir? Salary means basic, DA for retirement, plus commission as a percentage of turnover. Suppose no, employee got HRA from April month to December month, 9 months. Only these 9 months related basic DA commission you should take. You should not take other months related. For example, no, in April month, for example, in December month, January related salary received in advance, it is taxable. I agree, it is taxable. Arrears of salary received in April month related to last year's. But these salaries are not belonging to April to December month. So when you are computing salary for HRA, RFA, for what period you are computing salary, for that period what is basic, for that period what is commission, for that period what is DA, only that has to be. So the salary definitions are generally considered for relevant period for which you are computing, taxability, exemption, all that. Now, again, no, you see, like if you remember, salary word is used at so many places. For example, contribution to RPF, up to 12% of salary, nothing is taxable. Beyond 12% of salary is fully taxable, right? Salary means what? Voluntary retirement compensation, salary point is there. Gratuity where act is not applicable, 15/30, nothing but 1/2 into completed years of service into average salary. Salary means what there? And leave encashment, unavailed leave, 10 months into average salary, and average salary multiplied by unutilized leave divided by 30. That logic is there, right? Their salary means what? Salary means in all these cases, contribution to RPF, VRS, gratuity where act is not applicable, leave encashment, and even HRA, rent paid minus 10% of salary, 50% of salary, 40% of salary. Salary is there, right? In all these cases, salary means what? Basic. Salary means what? In all these cases, basic salary you take for that period. DA, that too for retirement benefits DA only you should take. Commission as a percentage of turnover. Now sometimes in exam, no, they will not tell you DA retirement. They will say DA forming part of salary. DA forming part of salary, DA for retirement. Whatever the word is there, we will call it as retirement DA. That's it. If nothing is given, for example, in exam they just said DA and elements, nothing is mentioned. We assume that it is not forming part of retirement. We assume that it is not forming part. They didn't mention anything about DA. They just said DA is there, but nothing is mentioned. Then suppose no, where gratuity, suppose employee received gratuity, where he is covered under payment of gratuity act. That time exemption is how much? 15/26 into last drawn salary into completed years of service or part thereof in excess of 6 months. Yes or no? Last drawn salary. Salary means what? Basic plus any DA. Any DA. They didn't mention which DA, retirement or non-retirement. Any DA. Entire DA you have to add. Any DA. There is no commission, nothing. Retrenchment compensation purpose, salary definition is different, but that is not relevant from exam point of view. From exam point of view, retrenchment compensation is not that important. Okay. Then RFA. You remember rent-free accommodation? How much is taxable per visit in RFA? Government, license fee. Hotel accommodation, 10% of salary or actual rent. I mean, sorry, rented accommodation, 10% of salary or actual rent, whichever is lower. Hotel accommodation, 24% of salary or actual rent, whichever is lower. 24% of salary, 10% of salary. Like salary means what? Basic. Salary means what? Basic for that month. For example, employee has got somebody is asking where do we get this notes. Description, there is a link. Comments also there is a link. Please download there. Google Drive link is given. Okay. So basic plus DA for retirement you take. Any commission, percentage of turnover, other than that, leave it. Bonus you take. Taxable portion of allowances. Remember, the employee will be getting personal allowance, official allowance, telephone allowance, so many allowances. Leave encashment received during service. Leave encashment received during service. Pension received during service. These are all treated as allowances. Generally, pension point will not be there because pension, leave encashment, gratuity, they are all received after retirement. That time only exemption and all will apply. But before retirement, if they took, getting it, taxable portion of allowance, you should consider that. Okay. So now salary for which months? For example, I am computing RFA per visit value for April, May, June, July, 4 months only. In exam, in question also 4 months only they said. Later employee did not, he returned it. He surrendered accommodation to the company. He did not take any accommodation, for example. So fine. So for 4 months only is getting. Only those 4 months related basic how much? Only those 4 months related commission how much? Only those 4 months related bonus how much? Sometimes bonus will be given annual figure, monthly figure they won't give. That time you will take only for 4 months. Bonus, for example, they give 12,000 into 4/12. For 4 months only you are computing RFA rate, only for 4/12 you should take. Leave encashment they gave. In September 24 attempt they gave leave encashment received during service. They gave just 10,000 rupees per annum, full year. During service they got. It's treated as allowance. So 10,000 multiplied by 4/12, you should take that. Because 4 months only you are computing RFA here. I hope you understood salary for various purposes. Okay. Now again go back. Now so much is there, no? Not that easy taking revision like this, because we have to cover so many points. We have to remember your timeline. Day after tomorrow exam is there. Apart from this, you should also cover GST. Apart from this, you should also cover my other revision classes there for detailed revision purpose. You need to at least once read. Imagine the kind of toughness that I have to face. So stressful. Pension is two types: uncomputed, computed. Uncomputed means what? For example, you retired from the company. The company gave you two options. Sir, I will give you 5,000 rupees per month, monthly. Okay, 5,000 after retirement. That's uncomputed pension. Suppose you asked the company, sir, company asked you like this, sir, 5,000 per month I'll give you, or I'll give you 5 lakhs, sir. Whichever option you want, I'll give you. Anything is fine for me. You told company, sir, do one thing, sir. 3,000 per month only you give me. For 2,000 I'm not taking. 2 lakhs you give me lump sum amount. Employee is clever. He's putting the request back to the company, sir, I'll take only 3,000 per month. 2 lakhs you give me lump sum. This lump sum is called as computed pension. Whatever monthly amount which he agreed on, that is called as uncomputed pension. Sometimes in exams, they'll give you, for example, see, these are all crux points, if at all. For example, employee retired on 1st December 2024, where monthly pension is, for example, 10,000 per month. In problem, what they will give, on 1st February 2025, 50% commuted, 50% commuted for 5 lakhs they will give. 50% commuted for 5 lakhs they will give. But what our students will do, 1st December to March 31st into 4 months, 40,000 uncommuted pension they will tax it. Wrong answer. Yeah, when you retired pension is 10,000 per month, but remember 1st December 10,000 per month, December month 10,000 per month, January month 10,000 per month, but February 1st no, he commuted 50%, he will only get 5,000, March month 5,000, so total uncommuted pension he will receive in that financial year is 30,000 only. Be careful. Retirement date when, commutation date when, be careful. Now, okay, fine, sir. I understood uncommuted. What about 5 lakhs money he received? No, he received 5 lakhs, no, commuted pension. Sir, government employees are fully exempt. Non-government employee, check these points. Is he receiving gratuity? Check out. Or not receiving gratuity? Sir, he is receiving gratuity also, sir. Then how much is exempted? 1/3 of full pension value is exempted. Sir, he is not receiving gratuity, then half is exempted, 50% is exempted of full value. Remember, he received 5 lakhs. This is not full value. 5 lakhs he received for sacrificing 50%, which means full value is how much? 5 lakhs he received for sacrificing 50. So 100% means what? 10 lakh. So how much is exempted? So, sir, private sector employee, sir, 5 lakhs pension he received, sir. Now he is also getting gratuity amount, sir. He is getting exemption there also, exemption here also. That's why lower exemption, 1/3 of full value. Just now computed full value, 1.33 lakh. Sorry, 3.33 lakh is exempted. Okay, sir, suppose he is not receiving gratuity, sir, then full value into half. Full value just now we computed 10 lakhs, so 5 lakhs. So 5 lakhs he received, 5 lakhs he received, half of full value 5 lakhs, computed pension taxable is 0. He is receiving gratuity, then 1/3, 3.33 lakh, taxable amount will be 1.66 lakh. That's it, pension is here. MCQ purpose, what might be relevant, what might be relevant, pension received, disability pension given to employees of army, yes or no, where the disability was due to operations. When they were in operations, no, they were affected badly and they are getting disability pension, that is fully exempted. Suppose a person from defense sector, he retired normally, a person employee working in defense sector, army and all, he retired normally and he is getting pension, no exemption, fully taxable, uncomputed pension. Okay, and a person who is receiving pension, Paramveer Chakra, Mahavir Chakra, if they are getting any pension, no, that is fully exempted. Okay, if the family members are receiving pension, that is fully exempted. Where these awards were there, no, like these, Paramveer Chakra, Mahavir Chakra, these awards were there, right? Their family members are getting family pension, that is fully exempted. That's it. That's it. And remember, for pension, no, tax regime link is not there. There is no link with optional tax, default tax, nothing, no link. That link is there for allowances and perquisites only. No, for there is no, the link is not there for any other stuff. Leave salary, 10 subsection 5, HRA, special allowances for personal purposes, and special allowances, nothing but personal allowances, official allowances, uniform helper research. Only there, default tax regime link is there. Food and beverages, 50 rupees, there, default tax regime link is there. That's it. I hope every one of you are able to understand. I want your reply, whether you're all with me or not. Almost 1.5 hours it's been we started. Just reply me, I'll proceed further. Are you all with me, able to understand? Yes, very good. Yeah, perfect, thank you. Fine, next what we need to understand, gratuity. How much is exempted in case of gratuity? Remember, gratuity received during service is fully taxable. Gratuity received during service is fully taxable. Somebody is asking, Raghavendran, yes, it worked. Raghavendran, 3/4 strategy, is it worked? Yes, it worked. 3/4 strategy will always work, trust me, because out of 10 chapters, some 2 or 3 chapters you are leaving, rest 7 8 chapters you are 100% studying, no, only from 2 chapters they'll ask 8 marks question, no, right? That's the logic. Okay, 3/4 strategy will work irrespective of toughest paper, easy paper, doesn't matter, because you are studying 100% chapter, 100% of the chapter you're studying. So 3/4 strategy will work always. Now next, received during the service, fully taxable. And in fact, no 3-4 strategy related, we will also give you a detailed video. Each question came from 3-4 strategy or not, we will tell you. 90 plus marks came in the today's law exam. 90 plus marks question came in from 3-4 strategy. September 25 law, 90 plus marks came from 3-4 strategy. Bet we will give you a mapping also video. Now, gratuity received at the time of retirement or death. That time how much is exempt? Government employee, received by government, defense employees, government, central governments, local authority employees, government, state government employees, fully exempt. Non-government employees, they're getting. Sir, he is covered under gratuity act, sir. That time how much is exempt? Least of the following. Maximum is 20 lakh and actual gratuity amount, 15 by 26 into completed years of service or part thereof in excess. For example, employee worked for 28 years and 8 months. It is treated as 26 years. Suppose employee worked for 24 years 4 months, then it is treated as 24. So complete years. Okay. And last drawn salary. Last drawn salary means what? When you're retiring, no. That time how much is your basic salary? That time how much is your DA? Only these two we will consider. So salary means what? For the purpose of, you see, hash mark I have given you. Salary where act is applicable, basic plus any DA. Suppose no. What happened? Yeah, fine. So suppose if act is not applicable, then average salary you should compute. Average of last 10 months salary. Average of last 10 months before retirement month. Suppose you retired in February month, then April to January you should take. You retired in December month, then November is the 10th month. So last 10 months you should take. So March onwards you should take. No. February onwards to November. These are the 10 months period. So for 10 months, what you should take? Basic plus DA for retirement plus commission percentage of turnover. Sometimes when you're taking last 10 months, some increment might have been there. Be careful. Okay, suppose in the last 10 months, for example, before 1st April, salary basic is different, DA is different. After 1st April, basic is different, DA is different. So be careful. Okay, 20 lakhs are actual. So whichever is lower, accordingly exempted. And remember, 20 lakhs is the lifetime limit. 20 lakhs is lifetime limit exemption. Suppose, I am getting gratuity from 2 employers. From one employer, I got already 10 lakhs. I claimed some 7 lakhs exemption. Now I will consider only 13 lakhs per criteria checking, not 20 lakhs, because 7 lakhs exemption I already claimed. Then we have something called leave encashment. This is this one adjustment. Leave encashment is one where 90% of the students do wrong. 90% of the students are doing wrong in leave encashment. That to where they will be doing wrong. Fourth criteria, cash equivalent to unavailed leave. All this. Here I developed one formula. Okay, fourth criteria. How much is exempted by the leave encashment, sir? Leave encashment received during service, fully taxable. It is treated as allowance. Okay, leave encashment received by government employee, fully exempt. Leave encashment received by other employees, 4 criteria were there. Criteria 1, 2, 3 and then 4. How much is exempted? 25 lakhs is maximum exemption limit. What amount actually received? Identify that. Last 10 months multiplied by salary. 10 months salary, how much? That much. Or cash equivalent to unavailed leave based on last 10 months salary to his credit at the time of retirement. Earned leave entitlement cannot exceed 30 days for every year of actual service rendered. Many students do wrong answer here. How to compute here? I'll tell you this particular 4th criteria. I will tell you simple logic. In exam you got leave encashment. Apply this logic. Apply this logic. Completed years of service, how many? First identify that. Sir, 25 years, sir. Okay, 25 into completed years of service into how many leaves company policy is there? Every year, how many leaves employee is eligible? In the question 45 days, they said, sir. They said 45 days leave, employee is eligible. They said, oh, 45 days eligible. Every year, don't take that. The only maximum. Sir, 25 days only every year eligible, sir. Then take 25 here. So first identify gross leave available. Gross leave available identify. Gross leave available means what? Complete year of service into maximum 30. 25 into 30 is equal to 750 days is the gross leave available. Gross minus how many he utilized, identify. Utilized. Sir, 450 utilized, sir. Then how much is the unutilized leave? 300 is the unavailed leave. This is the number. So salary equivalent to unavailed leave, that word is there, right? Unavailed leave. First, unutilized leave divided by 30 into average salary. This is the formula. How to compute unutilized leave? Gross leave available minus leave utilized is equal to unutilized leaves. When you are computing gross leave available, completed years of service into leaves per annum available, how much identify, gross leaves per annum. Now company policy 40 days, 45 days, 50 days, 35 days, that and all is there. No, don't take. Maximum company policy or 30, whichever is higher, whichever is lower, that much only. Suppose if company policy is 40 days, then per annum 30 only we will consider. Like that you consider gross leave available. We calculated 750 days minus leave utilized. That leave utilized in problem they'll give you 450 days. Sometimes if the paper has to be tough, yes, ma. Somebody is asking, is this live? Yes, it is live. Okay, fine. Sometimes in exam what they do, they will give you unused leaves or some 300 unused leaves or some 300. Okay, this 300 unused leaves are calculated based on 40 days company policy. An employee completed 30 years of work. 30 years he completed 30 years. Every year, for every month 40 days eligible. Like that 300 days were unutilized by him. Now here how you should compute reverse calculation. First to know employee is eligible for 1200 leaves minus unutilized is 300, means how many leaves he utilized? 900 days he utilized. Now you computed utilized leaves, right? Now calculate unutilized leaves as per 10 subsection 10 AA. Completed years of service how many? 30. Leaves available company 40 or 30, whichever is higher, 30 only is equal to 900. Gross leave is 30, 900. Already employee utilized 900. So unutilized leave is 0. Exemption will be 0. Some students what they do, unutilized leave 300. Oh, 300 divided by 30 multiplied by average salary, they'll put wrong answer. So here 300 days were computed based on 40 days logic. Suppose in exam, no, they gave unutilized leave, which is computed based on 30 days logic only. Then no problem. Straight away unutilized leave divided by 30 multiplied by average salary. Suppose if this is based on 40 days logic or some other logic, then first you should identify actual leave utilized by him how much. Then you should apply completed years multiplied by 30 minus actual leave utilized. Therefore you will get unutilized leave as per the income tax law. I don't know whether how many of you get this point. Okay, if the paper has to be tough, if at all this adjustment they want to twist, this is how they can twist. With this, leave encashment is over, gratuity is over, and even leave encashment is also. Contribution to RPF. Sometimes in exam they'll give you contribution to recognized provident fund. Okay, excess of 12% is taxable rate, up to 12% is exempt. What many students will do, here mistake, for example in exam they'll give you employer company contributed 20% of salary, 20% of basic salary. For example, they said 2 lakhs. Our students are so smart. What they will do? 2 lakhs multiplied by 8%. Okay, somebody saying recorded one. Mike is saying recorded one. Sandwich is saying, is this live? Array, yeah, it is a live class, yeah. Okay, it's a live. I'm doing it live. So the 2 lakhs into 8%. Straight away, how much it is? 16,000. They will tax it. Wrong. That's not how you should compute. Sir, 20% of basic salary. Yeah. For example, okay. RPF contribution. How much is contributed? 2 lakhs. Okay, minus exemption. How much? 12% of salary. Salary means what? Basic plus DA for retirement plus commission percentage of turnover. Okay, for example, no, basic salary is 10 lakhs only. 10 lakhs. DA is 5 lakhs. Commission is, let us assume, 0 for the sake of convenience. 10 plus 5, 15. Okay, 15. 15 into 12. How much it is? 180. 1,80,000 exempted. Okay, so balance 20,000 only taxable. Whenever you are calculating taxable RPF, whenever you are calculating RPF taxable amount, you must do like this only. Don't go for shortcut. Straight away 8%. Never. First turn it to money. Some percentage of something they contributed. First identify how much they contributed. Minus exemption. Up to 12% of salary. 12% of what and all? Basic plus DA for retirement plus commission percentage of turnover. Calculate like this only. Then identify taxable RPF. Then put it in gross salary computation. Next, perquisite. You see in perquisites, no, rent-free accommodation. In the problem, if at all RFA is there, don't compute RFA. Compute at last. Before reducing deductions. No, that time you compute RFA. Don't compute. Compute pension, compute gratuity, compute HRE, everything you compute. But don't compute RFA. Okay, don't compute RFA at beginning, compute at last. Because when you're computing RFA definition of salary is what? Basic plus DA for retirement plus commission, all that. Now anyhow, first let me discuss RFA. Okay, discussion wise I will discuss now, no problem. You see, RFA, I will give you a fantastic explanation where you will get all 100% clarity. Many students will have in RFA furnished, unfurnished, all that logic. Okay, nonsense. You see how easily I will show you, how easily I will crack it. You see, how to calculate rent-free accommodation perquisite? Very simple. First calculate gross value of perquisite. First calculate gross value. Then amount recovered from the employee. Okay, for accommodation purpose, how much you received? For movable asset purpose, furniture, all that, how much you received? Reduce it. Then taxable perquisite you will get. Now, what is gross value of the perquisite? Okay. Case 1, accommodation provided by government. Government provided the accommodation. Okay. How to value the accommodation? Accommodation is owned by government. License fee. That's it. Sir, accommodation is hotel one, sir. Hotel accommodation they provided, sir. In government only, hotel. Owner, rent, whatever it is, okay, amount. Hotel accommodation they provided. For government, it's always license fee. Okay, rented accommodation, that logic and all not there for government. Okay, owner, rented, doesn't matter. Leased, rented, owner doesn't matter. Straight away license fee. Hotel they provided. Then lower of 24% of salary or actual rent, whichever is lower, that much. And remember, if hotel accommodation is provided up to 15 days only in case of on account of moving from one place to another place temporarily, for 15 days only we provided, that is fully exempted. If hotel accommodation is provided for official duties at some other place, that is fully exempted. If employee moved from one city to another city, temporarily up to 15 days we provided hotel accommodation, then only it is exempt. Okay. Now, you got accommodation value. In accommodation, no, company also gave furniture and appliance. Company also provided furniture to the employee. Own furniture, company purchased and kept in the house. 10% per annum. Suppose employee was given 5 months only the furniture. If only for 5 months we gave, then 5 months only we should take 10% per annum of original cost. Suppose we borrowed, we took ACs and all on hire, lease, and then installed in the employee house, then rental expense. Then what you will get is gross perquisite value. This is how you should compute. Furnished, unfurnished. See, I didn't apply all those logics. First, for accommodation, own accommodation, license fee. Hotel accommodation, then I added furniture value, then gross value. So I put gross value. For example, gross value is, let us assume 10 lakh. Amount recovered 5 lakhs from employee. 5 lakhs is only RFA taxable. Over. There. For example, where accommodation is provided by some other employer, private employer, okay, not government. Then where the accommodation is company own property, company own flat, company own bungalow, and the city where the bungalow is there, more than 40 lakhs population, then house value will be 10% of salary. The value of the house enjoyed by the employee will be 10% of salary. If the population is between 15 to 40 lakh, then value of the house is 7.5% of salary. Any other area, 5% of salary. That is the accommodation value. Okay. Then, sir, I took on lease and then gave to employee, sir. Then 10% of salary or actual rent, whichever is lower. Sir, hotel accommodation, same government logic. So that's it. Then add furniture. 10% per annum of the original cost in case furniture is owned by employer. Rented employer, rented, rental amount, then gross value. Like this I computed. For example, here I computed accommodation value, some 10 lakhs I computed, furniture value 2 lakhs I computed, total 12 lakhs. So substitute the 12 lakhs EO, minus amount recovered from employees 5 lakhs, so automatically 7 lakhs is taxable. Now here you see 24% of salary, 10% of salary, 7.5, 5, 10% of salary, 24. Salary means what? Basic you take. Okay, and DA for retirement benefit you take. Bonus you consider. Any commission you consider. Taxable portion of allowances. Allowances will be there, only taxable portion you should consider. Exempted portion don't consider. For example, transport allowance 5,000 received, 3,200 is exempted, 1,800 only you should consider. Employee received leave encashment during service, and you are computing this RFA for 6 months only. Then total leave encashment received during service multiplied by 6 by 12. That much only you should take here. That's it. Gayatri, I have solved some examples, all that in main marathon is there, because if I sit and solve all that problems again fresh, it will take a lot of time for us. Okay, it will take a lot of time. That's the reason I'm not solving, but I'm Trust me, you just follow this format as it is, it will be very easy for you. Then now here in this RF, subsequent year valuation of perquisite in case of non-government employer, only for non-government employers only. Government employer, this logic will not apply. For non-government employer, subsequent accommodation, subsequent years. First year is what, we will call it as 23-24, or the previous year in which accommodation is provided, whichever is later. Okay. For example, we are doing problem for 24-25. 23-24 also employee got RFA. Now in 23-24, what is the perquisite value? Identify. Value in first year. 23-24 is first year, no? In that value, how much identify? Current year index number, you get it, 24-25. Last year index number, you see. Okay, denominator. Then you are getting some value. Let us assume some 14 lakhs you are getting. The value of accommodation, it cannot exceed 14 lakhs. In 24-25, suppose no, a minute. Suppose no, as per this logic, I computed accommodation value. As per this logic, I computed accommodation value. It is coming 16 lakhs in 24-25. Last year it was 12 lakhs only. This year, employee got higher salary. So basic everything got increased. Increment he got. Now, if I apply RFA logic this year, the perquisite of RFA is same. But house is same, no? House is same only. He got increment. But 10% of salary means it is coming bigger number now this year. So unnecessarily tax is becoming high, income is increasing high, So what? They put one cap here. What cap they are saying? In the current year, value of accommodation shall not exceed. First year, how much is the value? Identify, multiplied by current year CA 363 divided by 23-24. You got it, that year number. So how much you got? That much only will be the perquisite value for 24-25. If at all paper has to be tough, MCQ can come on this. With this, RFA is over. Okay. Actually, RFA salary definition is this one, right? This is the simplest form of definition I gave. But actually, in the ICA book, this is the definition they have. For RFA purpose, salary means what? This is the definition they give. So complex. This definition, I revised it into a simplest way, which I already showed. Then, compulsorily read motor car related one. Car means there are car owned by employer. Expense of the car is also employer only bearing. Car is fully for official purpose. Nothing is taxable. Fully for personal purpose. Own car, 10% per annum original cost, perquisite value. Rented car, rental expense, plus maintenance expense, that is perquisite. Sir, car is used for both official and personal purpose, sir. Then deemed perquisite value. What is the deemed perquisite value in case of car? It is there here. So, employer only owning the car, he is only bearing the expense, both official and personal expenses. Then up to 1.6 cc engine, 1800 per month is the perquisite. If it is more than that, 2400 per month or part of a month is the perquisite. Per month or part of a month means what? Calendar month. Sir, employee got the car on 10th April, sir. He surrendered the car to the company on 9th May, sir. Less than 1 month only used. No. April is considered separately, May is considered separately. 2 months we should calculate. Be clear with respect to MCQs like this you might get. Calendar month means what? Calendar month. Here you see I gave month means calendar month. Sir, employee got on April 12th, sir. He gave back the car to the company on May 9th only, sir. He didn't like the car. Okay, less than 30 days only, less than 1 month only he used. It doesn't matter. April month he got the car, May month also he have the car. 44 AE presumptive taxation, there also similar logic only. Yes or no? Calendar month means here. Okay, part of a month means even part of a calendar month you have the car. That's it. Perquisite will be calculated. Next. So, and if at all driver is also provided, 900 per month extra will be added. Suppose company employer is owning the car, employee is bearing expenses. Employer own the car, expense are employee is only bearing. Now here car towards car only perquisite 600 900, that's it. Sir, employee own car, sir, but employer is bearing expenses. Then it is not, I mean, official purpose, not a perquisite. Personal purpose, employer, whatever running expenses, that is fully perquisite. Sir, employee own the car, expenses company is incurring, and both official purpose. Total expense identify. First identify total expense, actual expense, minus deemed for official purpose. How much is deemed for official purpose? 1800, 2400, 900. These are all deemed for official purpose. Reduce it. Balance amount is taxable. Any other conveyance is getting 600, 900. That logic. This car facility is also over. This car logic is also over. Then food and non-alcoholic beverages. Food and non-alcoholic beverages up to 50 rupees per meal is exempt. Per meal, how much is exempt? 50 under optional tax regime. If it's default tax regime, fully taxable. Leave travel concession under optional tax regime, 2 trips are permitted. In a block of 4 years, 2 trips are permitted. Right now the block is 22, 2023, 24, 25. This is the block which is going on right now. Okay, so for your exam, 22, 23, 24, 25, 4 calendar years. Okay, this is the block. So in this 4 years gap, any 2 vacations, any 2 journeys, okay, only traveling expenditure reimbursed by the company is exempted. 2 journeys. Suppose the employee did not perform both the journeys, one he can carry forward to next block. In that next block, 3 journeys he can claim exemption for traveling expenses alone. Suppose if the company is reimbursing stay expenses, lodging expenses, some expenses for food and all, that is fully taxable. LTC exemption is only for travel. Okay. Medical facility. Medical facility, let me show you once better. Okay. Okay, education facilities that first we will see. If education facility is provided, if the education facility is provided for the employee's children purpose, okay, it employ children purpose. And if the cost of civil education, no perquisite at all, if the civil education cost is not exceeding 1000 per month, no limit on number of employees. If similar education cost does not exceed 1000 rupees per month, fully exempt. The similar education cost is crossing 1000, fully taxable. Fully taxable. If at all similar education cost is more than 1000 per month, that too for children purpose, then it is fully taxable. The education is provided for other family members, not children, then it is fully taxable. Whatever expenditure employer is incurring, that is fully taxable. That's it. You see, exemption of 1000 is not available if the education facility is provided to any other household member. Now here, it is not up to 1000 which is exempted. If it is less than or equal to 1000 value, if it is expenditure is less than 1000, exempted. If it is 1000 rupees or more than 1000, fully taxable. That's it. Gift also the same. Gift in kind, gift in cash is fully taxable. Education allowance is fully taxable. Under optional tax regime, 100 rupees per month per child for 2 children exempted. Remember, gift kind exempt if the value is not exceeding 5000, fully taxable if the value is more than 5000. Alternatively, in education facility and gift, in both the cases, alternative treatment is also there. Up to 1000 per month you can take exemption. Gift also up to 5000 you can take exemption. Both the views are permitted in reality. Okay, that's it. Even in our suggested answers also, both the views are permitted. Next, any other fringe benefit? Before I discuss all this, let me discuss medical facility first. Almost how much time? Oh, 1 hour 50 minutes. It's okay, good. We are going decently. Whatever provisions I'm showing here, if at all you are at least studying them, 99% you will perform the exam very well. Yeah, medical facility. You see, the following medical facilities are exempted. What are medical benefits exempted? Medical treatment provided to employee or their family member in employer hospital, fully exempt. Or reimbursement we are giving for employee in a government hospital related medical treatment or local authority hospital, any approved hospital, or for any specific diseases or treatment in any approved hospital, for that purpose exempt. COVID point irrelevant, now leave it. Suppose now for employee health insurance, company is paying premium. Company is only taking health insurance policy and employee health, or company is reimbursing for premium health insurance policy, fully exempted. But all companies giving allowance for medical policy purchase, allowance they give fully taxable. Medical allowance fully taxable. And medical treatment abroad, suppose employee or his family members is having some problem and they went for abroad for medical treatment, that is fully exempted. That is fully exempted. Medical cost and stay cost is fully exempt to the extent permitted by RBI, whereas travel cost and all is exempted only if the gross total income is not exceeding 2 lakh. This limit is set in 1991 year. In the recent Finance Act 2025, they revised this limit. Thank God. For May 26 attempt onwards, the revised limits will apply. Don't worry. For September 25 attempt, January 26 attempt, 2 lakhs limit only applicable. For May 26 attempt onwards, this limit is different. Okay, that's it. So that's regarding medical facility. Then what else is there? Education facility over, medical facility over, loan and then movable asset. If these two are completed, perquisite discussion will be over. Then deductions under salaries head of income. If that is also over, salaries chapter will be over. Okay. Now So loan. So here it will be their loan, you see. Any other fringe benefit? Any other fringe benefit here is there? Loan, you see. Loan is treated as perquisite. How much? You know, interest rate set by State Bank of India on 1st April of the year. No, how much State Bank of India interest rate is there? That you take. And what is the type of the loan we gave to the employee? Housing loan, a personal loan, a car loan, what loan we gave to the employee? Identify that. Okay, into interest rate, that much is the perquisite. Minus amount recovered from him. No, for loan given, any interest we are recovering, reduce it. Balance is tax. Now, uh, now this loan related perquisite will not apply if the loan amount is not exceeding 20. No need to calculate perquisite. Or if the loan is given for medical treatment of specified diseases, then also loan related perquisite will not be applicable. Then movable assets. Suppose no, we are giving employee furniture at his home. I already told. If we are giving employee car, we are giving employee some bike, some asset we are giving for usage only. Company property we are giving him for usage. That time no. Suppose if laptops and computers are given to employee for usage, 0. Telephone facility, 0. Movable assets other than laptops, 10% per annum of the actual cost. Company own asset we gave to employee, 10% per annum of the actual cost is treated as perquisite. Rented asset, actual rent amount. Sir, we sold an asset to the employee, sir. You know, we gave a car to employee. Sometimes in exam they'll give question like this. Company provided a car to employee 2 years back. He is using it. Okay, company own car only, but he is using it from past 2 years. In the current year, 1st October, he purchased this car. He purchased this car on 1st October. Then for 6 months, no, April to September, usage related 10% per annum original cost which perquisite should be charged. And he also purchased it, right? Market value of the car you should determine first. How to determine market value? Deemed market value. Original cost of the car identify. Less notional depreciation for every completed year of usage. When the company purchases the car, till the date of the sale, how many years completed years from the date of purchase. For example, date of purchase is 10th September. Then next year 9th September 1 year complete. That next year 9th September 2 years complete. That next year 9th September, sir, did not come. By the time employee purchases the car, 2 completed years only the car is there in the hands of the company. Then for 2 years notional depreciation reduced. Then balance is actually the value of the car which employee has purchased. This is the value of the car employee purchased. 10 lakhs is the value of the car, sir, but the employee paid only 5 lakhs, sir. 5 lakhs is taxable. So what is a notional depreciation? For computers and electronic item, 50% is a notional depreciation item. For cars, 20%, that too WDV method. For any other asset, 10% SLM method. So this is with respect to car. Okay. All the provisions in salaries we covered. Now finally deductions, standard deduction. First you should compute gross salary. In gross salary computation, rent-free accommodation shall be computed at last, because you first list out all the items, allowances, everything, list out taxable portion, everything. Then RFA you compute, it will be very easy for you. Okay. Now standard deduction. How much is the standard deduction? Flat 50,000 if it is optional tax regime. Flat 75,000 if it is default tax regime. Entertainment allowance, only under optional tax regime it is exempted. Suppose first of all, entertainment allowance first received is fully taxable, gross salary. Less exemption, OT or optional tax regime, it is exempted. That too for government employee only it is exempted. How much is exempted? 5,000 rupees per annum or 1/5 of the basic salary or actual amount, whichever is lower, that is exempted. Profession tax. Sir, profession tax company paid, sir, then it's a perquisite. Profession tax paid by the company only, then it's a perquisite. So there is an MCQ in case scenario book. Profession tax paid by the company is also treated as perquisite, remember. Okay. So first add it in the gross salary, then reduce here, that too under OTR. Suppose if the employee is declaring income under default tax regime, then these 2 points will not be there. That's it. Okay. Next. Then with the salary head of income is completely done. I hope you are clear. Fine. We'll take some 30, some, let me tell you, I will 9:05, right? 9:45 or 9:50, I will come back. Okay. So we'll take a break. We'll resume it 9:45 or 9:50, worst case 10 o'clock. Because my throat has to be little rest, because continuously from past 2 hours I'm talking. Okay. The live will be continued like this only. We'll just take a break and then get back. Okay, I will also have food and come. You also go have food and come back. So 10 to 12, or if possible 12:30 also, house property will finish, PGBP will finish. We'll try to finish clubbing, setup and carry forward. Capital gains also I'll try to touch. I'll try my level best. I hope you're able to understand how depth I am talking about all the provisions, especially where and all mistakes you will be doing. Okay, so kindly give replies, comment. How are you able to understand thoroughly or not? You're able to, like, all the doubts, are they being now rectified or not? Are they being now clarified or not? Okay, that's it. Okay, I'll just have the dinner and then come back. Hmm? Hope I'm audible. Somebody message me. Audible. Perfect. We'll proceed. So guys, let's begin income from house property revision. In income from house property, this is the computation format. And here I want to tell you one point. Under construction properties, MCQ might be possible. Under construction properties, no, they are not covered under house property. And if at all they are getting any rent from under construction property, that rent is taxable under income from other sources. That's it. Then what is the procedure to compute income from house property? First, you should compute gross annual value. How to compute? I'll come back. Then municipal taxes paid. Whatever is paid, that much is given as deduction, cash basis. Then net annual value we get. From net annual value, we have two deductions. One is flat 30%, 30% on this, and then interest on borrowed loan. Then the balance income is called as income from house property. But before this, uh, for any two houses, which are either self-occupied or unoccupied, either the property self-occupied or unoccupied. Unoccupied for what reason? SSE is having business or employment at some other place and he is not staying in this location. At some other place he is there, and this location, the property was not rented also. Then only it is called as unoccupied property. Suppose I am staying in Chennai. In Chennai only I have one more house which is completely vacant. I cannot call it as unoccupied property because I am staying in the same city, same locality. Are you getting it? But anyhow, this much level they won't test. Moreover, this was amended. Unoccupied property definition was amended in the Finance Act 2025, which is applicable for May 26 exams onwards. For you, don't worry. Okay. So for self-occupied, unoccupied, any two houses, NAV is equal to 0. Two conditions are there. You should not get any benefit from these two houses, and it should not be rented even for 1 day. Even if at all you rented it for 1 day, or you are getting some benefit from that property, NAV 0 cannot be claimed. So for two houses, NAV is equal to 0 can be claimed. Two conditions, only two conditions. Whatever property satisfying these two conditions, NAV is equal to 0. What are two conditions? The property is fully empty. It is not at all rented, or it is self-occupied, means not at all rented, and I'm not getting any benefit from that property, only that I'm staying. That's it. Me or my parents, some of us are staying, no benefit at all. Then only NAV is equal to 0 can be claimed. Suppose I have 5 houses like this. All the 5 houses I am not renting at all, I am not getting any benefit. All the 5 houses either I am staying or they are empty. Like that only is there. Can I claim NAV is equal to 0 for all the 5? No. Any 2 houses only you can claim NAV is equal to 0. Remaining 3, we will assume that it is let out property. We will call it as deemed let out property. If it is a deemed let out property, gross annual value we will compute. Remember, if NAV is equal to 0, we directly start the problem here. If NAV is equal to not 0, then compute GAV. For DLOP, GAV will be computed. For normal let out property, GAV will be computed. Now, how to compute gross annual value? How to compute gross annual value? Go for house property chapter discussion. Okay, main marathon is there, right? By the way, very simple. Go to my YouTube channel, see Harsha. Here there is a playlist. Tax day before exam, September 25. For example, if at all Jan 26 students are watching, the same 25 folder you can watch, or separately Jan 26 attempt folder will be once again added. Okay, there. Now you see here in this, I have 11 and 11 hours. You see here 11 hours marathon is there. Here you see I have given timestamps also. So house property, here I have clearly explained all the chapters. In-depth explanation is there in these marathons, numbers, computations, everything I did. Okay, TDS, TCS and AMT, total income, advanced tax, everything is covered in part number 2. And right now the live which is going on right now, we are watching, right? So that is there here, and GST day before exam strategy, I'll publish it. Okay, fine. Income tax, the day before strategy, everything, section combos and TDS, almost in this playlist. What are all relevant for exam? Okay, they were all added in this playlist. So go to CRM Harsha, you will find tax day before exam, September 25. And there you will have in-depth explanation for every topic. Here I just want to briefly cover the crux of every head of income, every topic. Now, so gross annual value. How to compute gross annual value? 3 steps. First, expected rent. What is expected rent? Fair rent or similar property rent, whichever is higher. Restricted to standard rent. Generally, expected rent is computed for 12 months. However, if I purchase the house or constructed during the year only, for example, completion certificate is 30th June. 1st July only onwards you can expect the rent, which means 9 months only expected rent. Sir, April 1st onwards property is there, but I sold it on 31st December. Then 9 months only you can expect the rent. So if the property is purchased or constructed during the year or sold during the year, whatever the period for which you are owner, then for that period only expected rent will be computed. That is step 1. Step 2, actual rent received. How to compute actual rent received? Receivable how much? How many months rented multiplied by that monthly rent. So receivable minus unrealized rent. Rule number 4, 4 conditions. Look at the detailed marathon, you will get there. Now actual rent received you will get. Step number 3. If step number 3 is higher than step number 1, straight away step 1 or step 2, whichever is higher. Suppose no, if step 2 value is less than step 1 and the property was vacant during the year, part of your property was vacant, then step number 2 is the right value. Add vacancy period rent. Now see step number 2, revised value with vacancy period rent. Is it higher than step number 1? Yes. If that is the case, actual rent received is less than expected rent because of vacancy, then gross annual value will be original step 2, actual rent received. That's how actual rent received will be computed. Municipal taxes, then net annual value 30%. Everything is over. Now interest deduction. Interest is given as deduction in 2 parts: pre-construction period interest, current year interest. What is pre-construction period interest? Very simple. Property construction is completed on 1st January 2025. Which financial year? 24-25. 1st January 25 comes under which year? 24-25. So before this year, 31st March 2024. So pre-construction period means the period ending 31st March preceding year of completion of construction. That's the definition. So which year the property completed, first identify. Date of completion you see. It comes under which financial year you see? Before 31st March. That is PCP. Suppose if loan borrowed and construction completion both are in the same year, PCPI concept will not apply. Okay, fine. Suppose PCP is there. Okay, from borrowable date till 31st March before the year of construction. For that period, compute total interest. That interest can be claimed in 5 installments. You can't claim at a time. Okay, PCPI can be claimed in 5 installments. First installment will be from the year of construction. Okay. In PCP, before year of construction, loan amount, interest amount be computed. What about the year of construction? That year also loan outstanding, that year also interest is there. That is called as current year interest. 1/5 of PCPA plus current year put together, total interest. Whatever total interest is there, you can claim deduction. Total interest you can claim. However, if at all NAV is equal to 0, you claimed. SOP, UOP benefit you claimed, where NAV is equal to 0. With that you directly started the problem. Then interest deduction maximum will be 2 lakhs only. Then interest deduction will be maximum 2 lakhs. Interest limit will apply 2 lakhs. That to 2 lakhs when the limit is applicable, Remember, this 2 lakhs limit is per SSC, not per house. Be careful, it is per SSC. First per house we will apply to 2 lakhs limit. Then per SSC we will restrict it to 2 lakhs limit. Okay, now 2 lakhs. That to 3 conditions are there. Loan must be borrowed on or after 1999. Construction or purchase must be completed within 5 years from the end of the year in which loan was borrowed, and loan must be borrowed for purchase purpose or construction purpose, not for any other purpose. If the loan is borrowed for some other purpose, then the limit will be 30,000 only. Remember, 2 lakhs limit, 30,000 limit will be applicable only when NAV is equal to 0. That too, interest deduction, no, you will get deduction only under optional tax regime. If NAV is equal to 0, interest deduction you can claim that too only under optional tax regime. Suppose NAV is equal to 0. And it's a default tax regime. What is it? It's a default tax regime. No deduction at all for interest. Whereas for LOP, DLOP, optional or default, doesn't matter. You can claim deduction towards interest. How much? 1/5 of PCPI plus current year interest. Total amount you can claim. Whatever amount you can claim. Net result can be loss. It can be more than 2 lakhs, 3 lakhs, 4 lakhs, 5 lakhs, whatever. Now, when you're computing interest deduction, pay attention to 80E. Okay, what is 80EE and EEA? I'll come back to chapter 6 deductions. This point you need to go. Okay, that's it. Now, some Aditya is asking it out. How pre-construction interest the loan and interest percentage is given, and principal of certain amount paid every quarter as they calculate from June. If that information is given in exam, they'll give you what is the average outstanding amount. Don't worry, you don't have to calculate month-wise breakup and all. So here the point they will test in exam is income tax provision. They will not test arithmetical calculation accuracy, all that. That's it. Next. So for LOP, DLOP, there are no limits on deduction. Very simple. Part of your property let out, GAV will be computed. Everything will be computed. Property is not at all rented, no benefit, then NAV is equal to 0. That's it. Then sometimes SSA will also receive arrears of rent. Means last from long years onwards, some rent is pending, unrealized rent, arrears rent, that now SSA received. Whenever you receive, that is taxable on cash basis. Whether the house is existing or not, whether you are owner or not, 30% deduction is available. Sir, I have a property. I'm a real estate dealer. Sir, I have so many flats. I constructed one gated community. So many flats are there. Stock in trade is there. For 2 years, NAV will be nil. For 2 years, NAV will be nil. Okay, your stock in trade, 2 years, NAV will be nil, provided no renting activity. Suppose if at all you're renting, NAV will be coming. Gross annual value will be computed. The moment you rent for part of year, gross annual value will be computed. Throughout the year, it should not be rented. Then only NAV is equal to 0 straight away. Income will be that property will not be accessible. That too further, one more point. Suppose, sir, there is a company, sir, or there is an SSC, sir. For him, business itself is renting houses, sir. Then again, PGBP head of income will apply. That time, house property head of income will not apply. PGBP will apply. Whatever house properties for that, they will be treated as fixed assets, buildings. 10% depreciation can be claimed. Remember that. Next. Composite letting. What is composite letting? Sir, I'm letting building plus furniture, sir. Furnished house I'm renting, sir. Now, furnished house you are renting, right? In composite letting, we need to see, is it separable, inseparable? Inseparable means what? If the tenant want house, only house he can take only house, or he want furniture also, he can take furniture. Only house he want, he can take only house. Furniture we will take back. Suppose no, if you want to take house with the furniture only, you can take. Both you should take. You should not either take both or don't take at all. If this is the kind of condition, then that is called as inseparable letting. If at all option is given to the tenant, then that's a separable letting. Some students, what they think, for house property 10,000 rent, sir. For furniture 2,000 rent I'm charging, sir. 12,000 rent monthly I'm charging. Straight away 10K taxable on house property. Furniture is taxable under other sources. No, that's not how. It's not about the breakup. It's about the letting. Okay, is it separable letting or inseparable? Even suppose if you take both together only you should take. Otherwise not. Otherwise you can't take. But I know for 10,000 is house, 2,000 is for furniture. I know breakup, but renting is inseparable renting. Therefore, it is taxable straight away fully 12,000 under other sources or PGBP. That's it. Next, so under construction properties point, everything I covered. Literally, house property head of income is over. Easy. See, 10 minutes. Major points I covered in house property, just 10 minutes. The entire crux I covered. And if you want to have a detailed understanding on house property, half an hour revision I covered in the playlist which I showed. Okay, half an hour explanation will be there on that. Next, then PGBP. Companies not covered under speculation. I'll show you. There are some companies which are not covered under speculation. We'll go to PGBP first. So remember, speculation, this is important for MCQs. Companies whose gross income mainly consists of securities interest, house property, capital gains, income from other sources, nothing but these are the companies which are like, for example, NBFCs, or companies which are engaged primarily in trading in business of banking, granting loans, nothing but here it is there. Banks and NBFCs, here it is there. Okay, are companies whose primary objective is interest on security, housing, all this. For all these companies, speculation concept itself will not apply. The following companies are not deemed to be speculative businesses. For a company whose main income is this, and if they are buying and selling securities, they will not be treated as speculation. Or if a company which is engaged in trading in shares, or a bank or NBFC, for them, if they are getting profit or loss on buying and selling of shares, that is not treated as speculation. And there are some transactions which are not at all treated as speculation transaction. These transactions, hedging contracts, not a speculation. Hedging contract for raw material stocks, not a speculation. Forward contract. Trading in derivatives like futures and options. Trading in commodity derivatives, that is also not a speculation, provided CTT is applicable. If at all a commodity derivative CTT is not there, then that is not a that is treated as a speculation. If CTT is applicable commodity transaction, then it is not a speculation. Remember, agriculture commodities, no, CTT does not apply. Just because CTT does not apply on agriculture commodities, still it will be treated as commodity derivative. It is not at all. It is not treated as speculative. That's it. Now, speculation and non-speculation, the loss has to be separately calculated. Speculation business income under PGBP has to be calculated separately. Non-speculative business income under PGBP has to be calculated separately. Now, so I think I clearly explained both. Next, deduction under section 30. Regarding that, one clarification. 30 means what? It is dealing with building expenditure. Deduction related to building. Suppose I have a house. Okay, I have a house. What is the house I have? Okay, like I have a house, ground floor and first floor. First floor is house property. I'm using for my personal purpose. Ground floor I'm using for my shop. For this house, municipal taxes paid by me 10,000. Then if the 10,000, then for shop, 5,000 rupees I will claim under PGBP as a business expenditure. 5,000 rupees I will claim it and from gross annual value. But since it's a self-occupied house, NAV is equal to 0. This 5,000 I will ignore completely, because NAV straight away I will start with 0. And for the same house, I spent repairs and maintenance of 10,000 rupees I spent in the entire year. 5,000 ground floor I will claim under PGBP. Remaining 5,000 repairs I will ignore related to house property. Relating to house property, repairs cost I will ignore. On the same building, I took a insurance policy where 5,000 insurance premium I paid. 50% for ground floor, 2,500 I will claim deduction under PGBP. Another 2,500 I will ignore. On this house, I borrowed a loan. I borrowed loan for constructing this building. I am paying per annum 10 lakhs interest I paid. 5 lakhs is related to ground floor, right? PGBP. I will claim deduction under PGBP. No limit at all. Remaining 5 lakhs, I will claim under house property. But since NAV is equal to 0, maximum deduction is 2 lakhs. That too, if it is default tax regime, maximum deduction is 0. That's it. I hope you understood now. So in exam, if house property is given, use it for both business and house property purpose, then proportionate expenses for business actuals we will claim deduction. Whereas in house property, as per provisions of house property, we will claim. That's about deduction for 30. Then so buildings partly used for business and partly for residential, proportionate deduction under 30 towards business purpose. Remaining amount for official accommodation, residential purpose, house property provisions will apply. Then now next, coming to depreciation under section 32. Depreciation, there are first some important depreciation rates you must remember. Important depreciation rates. Okay, page number 80 in our GOAT notes. Look at. So there are some important depreciation rates which every one of us must remember. A minute. Yes, you see. In income tax we follow something called block of asset approach. Block means what? Asset falling under same category and carrying same rate. Categories, how many we have? We have totally 4 categories: intangible, building, furniture, plant and machinery. Any asset which is not an intangible, which is not a building, which is not a furniture, is a plant and machinery. Mobile phone, not a building, not an intangible, not a furniture. So automatically let's say plant and machinery. So asset falling under these category and have same rate of depreciation, they all come under a single block. Like in this important rates are there. Now for example, for intangibles, straight away depreciation rate is 25%. For furniture, depreciation rate is 10%. Buildings which are used for commercial purpose like factories and all, 10%. Staff quarters, buildings used for residential purpose like staff quarters and all, 5%. Okay, now again buildings which are temporary wooden structure, water treatment, straight away 40%. Now next, plant and cars. Okay, for example, you see motor cars which are purchased between 1920 year, that to August 2020 to 2019 to 31st March, then 30% is the rate of depreciation. Buses, lorries, generally 30, but if the same bus lorry is purchased between August to March 2020, then 45% is the rate. Molds which are used in rubber and plastic industry, semiconductor industry, 30%. Then aeroplane engines, pollution control equipment, solid waste, life saving, electric vehicles, all electric cars, battery based or fuel power based cells, whatever it is. For example, there are something called hybrid cars are there. Hybrid in the sense, they work on plug-in hybrid we call. They work on fuel as well as battery will also be there. So that car, okay. So EV cars, what is the rate of depreciation? 40. Now here, sir, EV car 40%, building wooden structure also 40. Can I group them into single block? No. This car comes under plant and machinery block. This temporary wooden structure comes under building block. Category is different, rate is same, category is different, so they both will not come under same block. Be careful. Okay, so EV car, airplanes, buses, cars, everything comes under which category? Plant and machinery category. And if they have same rate, like for example computers, software, printers, computer printers, books, energy saving devices, windmills which are all running. Okay, for windmills, any special device like generators which are all installed on or after 1st April 2014. Remember, windmills and all installed on or after 1st April 2014, only 40% depreciation. Suppose if the windmills are installed before 1st April 2014, 15% block. So all this will be grouped into a single block. That's why you see, in income tax at CA interlevel, how many blocks we have? Intangibles, 1 block. Buildings 3 blocks. 1, 2, 3, 3 blocks in buildings. Furniture, only 1 block. Plant and machinery, you see, plant and machinery 30% block, plant and machinery 45% block, plant and machinery 40% block is there, plant and machinery 20, and plant and machinery 15. There are only 5 blocks of plant and machinery which is there. That's it. I hope everyone are able to understand. This is regarding rates of depreciation. I also spoke about block of method, WDV block of method. Just now I told definition also. Okay. Now, what is the depreciation computation format? This is a fantastic format. If you follow this format, trust me guys, any problem you can solve. Depreciation. Fine. Okay, fine. First, depreciation computation. Here, you need to first check conditions as per section 50. On 31st March of relevant previous year, there are 2 conditions that you should check. Is there an asset part of a block existing or not? Check out. Part of a block existing means in the block so many assets are there. At least one asset is there physically or not? Check out. Is there? Value for depreciation is there or not? Check out. Value for depreciation, that nothing but written down value, we call it as. WDV is there or not? Check out. WDV means nothing but closing WDV before depreciation. Is the value there or not? Check out. Sir, value is there, block is there. Calculate depreciation. Sir, block itself is not there, sir. Or block itself is not there. Like opening block is there, sir. 31st March block is not there. Which means you need to compute straight away section 50 capital gains. And on depreciable assets, the capital gain is either, it's always a short-term capital gain or short-term capital loss. Getting it? So when block itself is not there, full block is sold, automatically we either compute short-term capital gain or short-term capital loss. Sir, block is there, sir, but value is not there, sir. Value is not there. And on this also, I clearly explained with the numbers in the detailed revision. I'm only now giving you in the detailed revision in the playlist I showed, right? In the playlist I showed detailed revision, right? There in the part 1 PGBP, you got depreciation. I clearly showed with values. So how section 50 apply, how section 32 will apply. I am here just reminding you that point. Okay. Remember, this is a revision class. Okay, that too day before exam revision class. You must have already understood all this. You have already finished marathon, all that. So numbers and all is not required for you to once again explain. Yes or no? So only conceptual explanation I'm giving you here. So that's it. So part of a block must be there. Value for depreciation, nothing but WDV of the block must be there as on 31st March before computing depreciation, that value. So both if at all there, then depreciation I'll compute. If any one is missing, then straight away I'll compute capital gains. Now look at so WDV. What do you mean by WDV meaning? When you're doing sum in exam, sometimes they'll give you WDV on 31st March 2024 10 lakhs. They'll give you like this. And they will give you 24-25 related additions details, deletions details, all that. Sometimes in exam they'll give you 31st March 2024 WDV as on. Many students will take it as opening 1st April 2024 opening 10 lakhs. That's wrong. In exam, if they mentioned WDV on 31st March 2024 and they didn't mention before depreciation or after depreciation, clearly they didn't mention, it's silent. We assume that this value is before depreciation. So the WDV as on 31st March, if 10 lakhs is there, rate of depreciation is block 15. So 1.5 lakh you reduce, then you will get 31st March closing WDV after depreciation 8.5 lakh. That will be the opening depreciation 8.5. So just because closing WDV on 31st March 2024 is given, don't think it is after depreciation. If they specifically mentioned after depreciation, then after depreciation. If they did not mention anything, then we assume that it is before depreciation. Be careful. MCQs and descriptive question possibility is there. So this is one confusing point which many students don't know. They think closing WDV means after depreciation always. No, if the word is closing WDV as on, in fact closing word and all will not be there. As per act, it is WDV as on 31st March. after depreciation, if they say clearly, then only that value is after depreciation, that will be equal to 1st April. Suppose if they did not mention that after depreciation, then that is WDV before depreciation. You calculate depreciation and then the balance will be the opening. Next. And manufacturing sector, SSC engaged in manufacturing activity. And for your information, printing business, SSC involved in printing and publishing, that is also treated as manufacturing activity. In sometimes in question, no, they'll tell you SSC engaged in printing. Since manufacturing word is not there, many students will forget about additional depreciation. Printing comes under manufacturing activity, so additional depreciation is available for printing operators. Then what is additional depreciation? 20% of the actual cost. And we all know, suppose if at all new machinery which is installed in the current year was used for less than 180 days. Less than 180 means what? Installation date is on or after 4th October. Installation date is on or after 4th October 2024. If asset is installed 4th October or after 4th October, it is used for less than 180 days. Then additional depreciation can be claimed only 10% of the actual cost. Another 10% you can claim in the next year. Okay, that's it. Now look at the format of depreciation. The first opening balance of the block on 1st April of the current year. Sometimes in exam they will not give you opening value, they'll give you closing value, 31st March of the last year. If nothing is mentioned, reduce depreciation in the last year and then consider the opening value. If you clearly mention that it is after depreciation, then take it as an opening value. Then add actual cost of assets acquired, assets put to use for more than or equal to 180 days. If the asset is installed on or before 3rd October, that value, total value of that asset, actual cost of that asset, asset put to use, actual cost of assets which are installed on or after 4th October, that value. Assets acquired but not installed means you purchased this but you have not yet installed. Or capital repairs, some capital expenditure you spent, okay, that one. So total, the gross value of the block you will get, gross value of the block, less money received in respect of part of a block sold. Suppose part of a block you transferred, okay, for example, opening value is 10 lakhs, additions 10 lakhs, total gross value 20, part of a block I sold for 10 lakhs. Still there is a balance part. Then closing WDV before depreciation 10. See, part of a block only I sold means part of a block is there, value is there, depreciation I will compute. For example, part of a block I sold for 30 lakhs. 30 lakhs I sold it for. Part of a block I sold 30. Value cannot be negative. So it can only be 0. Remaining 10 lakhs will be treated as short-term capital gain. That's it. Next, closing WDV of the block before depreciation. For example, 10 lakhs. For example, here you got, for example, 10 lakhs you got. Now this 10 lakhs, first allocate this value to, for example, here we purchased 10 lakhs, assets acquired but not installed, some 3 lakhs. Assets acquired and used for less than 180 days, 3 lakhs. Assets acquired and used for more than 180 days, 4 lakhs. 4 plus 3 plus 3, totally 10 lakhs it came. Now anyhow, value for depreciation is also here how much? 10 lakh. See, this problem I in depth explained in our full marathon also, but here also once again I'm just giving brief numbers. 10 lakhs is there. First, this value allocate for the asset which are purchased but not used. How much worth of assets we purchased during there but not used? 3 lakhs only. Yeah, then 3 lakhs you allocate here. Then allocate, second, allocate to the assets which are used for less than 180. That is also 3 lakhs only. Just now we saw. Balancing figure, out of 10, 3 minus 3, balance figure 4 lakhs. Here apply full rate, multiplied by 15%. Here apply half rate, okay, 7.5%. And here 0 rate. So you will get normal depreciation value. So total normal depreciation you will get. Next, additional depreciation you should compute. In respect of new plant and machinery only you will get additional depreciation. Now, asset acquired not installed, no additional depreciation. Some asset is there, some machinery C, installed and used for more than 180 days, actual cost into 20. Mission D is there, which is used for less than 180 days. For example, actual cost into 10. Last year, bought last year, that time used for less than 180. Balance 10% can be claimed in the current year. Total additional. So part 1 normal depreciation plus part 2 additional is equal to total depreciation. That value you put here. Then you will get closing WDV after depreciation. That's it. This is how you should compute depreciation. Next. You see, now explanation, section 43 subsection 1. One more important point. 43 subsection 1 is talking about what? Actual cost. As per 43 subsection 1, if at all any asset I purchased by paying cash more than 10,000. See, if at all asset cost is more than 10,000, it must be paid by account pay check or account pay demand draft or electronic mode, prescribed electronic mode. Then only that actual cost will be considered. If at all asset is costing more than 10,000 and the amount is paid by not account pay check, not demand draft, not electronic mode, some cash I paid or bearer check I paid or crossed check I paid. 50,000 worth of machinery I purchased, cross check I paid, bearer check I paid, cash I paid. Actual cost is 0. We will not consider that. We will not capitalize it. We will consider it 0. That is what is subsection 1, main one. Now to the same section, there are so many explanations. 1A, 2, 4, 4A, 5, 8, 9, 10, 13. There are so many explanations were there. Now all the explanations are not relevant. There are important explanations like 1A, 5, 8, 13. Look at explanations, actual cost calculation here. Now we are doing explanation 1. We'll do one thing. Explanation 1, no, I will explain it along with the 35 scientific research. There I will come. There I will cover. Okay. Now explanation 1 here. Conversion of inventory to capital asset. For example, no, I'm a furniture dealer and I have some furniture. Now in my furniture shop, I have office room. For my office, I need a sofa set. So I am only furniture manufacturer. No, my sofa set which I'm selling to customer. No, I will not sell that sofa. I will keep it in my office. Means my stock in trade inventory is coming into my fixed assets. Now I need to add that furniture in the block of furniture. At what value? Fair market value on the date of conversion. Generally, at what price you will sell to customer, that value will add in the block. Then what else is there? Explanation 1, 1A, okay. 5. Explanation 5. Suppose, no, I have a personal building, my personal house. I bought 10 years back. Now I am bringing it into my business purpose. I am using it for my office purpose now. I brought into business purpose. Okay. Now how much should be the when I purchased 10 years back, it was 20 lakhs cost. Entire 20 lakhs will I add it to the block? No. All the 10 years you are using it. No. So actual cost is how much? 20 lakhs minus notional depreciation for every year 5%. Because earlier it was a residential purpose building. So every year 5%. To reduce it. So balance whatever is there, no, that value you will add in the cost. Sir, I have other personal assets, sir. I have a car. 5 years back I bought a car for 20 lakhs, sir. Now I am bringing into business, sir. How much will be added in the actual cost of cars block, plant and machinery block? How much I should add? Entire 20 lakhs you can add. In cars, only for building, notional depreciation we will reduce. You see clearly I mentioned actual cost minus. No, nothing minus. Whatever actual cost you incur, no, that much. What is actual cost? First of all, you see actual cost refers to the actual cost of the asset to the SSE. How much I paid at the time of the asset. That is actual cost only. That's it. Next. 13. Explanation 13. 13 also actually very good. 13 also very good. For example, no, I purchased an asset for my specified business. I have specified business also. 14 specified businesses were there. For specified business, I purchased some asset, and from that business, I'm bringing it to my normal business. Okay, I'm bringing it to my normal business. Okay, through any modes under 49(1) whatever. Okay. So SS is bringing it to normal business, or some previous owner have used it. Now I'm getting it to my normal business. Actual cost minus deduction. Suppose, no, I am bringing it within 8 years. My business only, I purchased for specified business. And I need to use it for specified business for 8 years at least. If at all I am not using it within 8 years, I am using it for some other purpose within 8 years. Then actual cost minus notional depreciation. That much amount is taxable first of all under 7B. Because no, for 3580 purpose you bought an asset and claim a deduction. Now 8 years you must use it. If at all you are not using it for 8 years, no, whatever earlier deduction claimed minus notional depreciation, balance amount is taxable. Whatever is taxable, that much amount is added in the block. That's what provision 213 says. It's 3580 crux. Okay, this point again, in-depth explanation I have given in detailed marathon. Okay, that's it. I'm just reminding you, these are all crux points. So many were there which you may not remember until now. Okay, that's it. Next. Then sale of asset used for scientific research. In scientific research, no, directly you can spend money. Scientific research, directly you can spend the money. Whatever you spend fully deductible. Optional tax or default tax doesn't matter. By the way, remember in PGBP, additional depreciation you can't claim under default tax regime. 3580 deduction you can't claim under default tax regime. Scientific research related donations, social research donations, you can't claim deduction. These are all restrictions in default tax regime. I have given at last. DTR restrictions in PGBP. What are DTR restrictions? You can't get additional depreciation. You can't contribute as per 35. I mean, even if you contribute, no deduction, and no deduction for 3580 under default tax regime. Okay. Now, suppose, no, I purchase an asset for scientific research. I will claim 100% reduction because I am using it for scientific research. So I will claim 100% reduction. Later I sold it directly. Then 41 subsection 3, whatever the amount you are receiving is called as deemed profit. 41 subsection 3. Sir, I am not selling it, sir. From that asset, no, from scientific research, no, I'm transferring it to my normal business activity, sir. Then 43 subsection 1, you need to add it into the block of asset. You need to add at what price. Explanation 1, you see here, explanation 1, if an asset is used for business or purpose, after it is used for scientific, originally it is used for scientific, then later you are bringing it to normal business, then actual cost minus deduction under 35, generally the value will be nil. That's it. If at all you are directly selling, whatever amount you are getting is deemed profit. You are bringing into block, then you are selling from block. Then if at all once it is bringing into block, then you are selling it, part of a block transfer, that treatment will apply. I hope you are able to recollect all these points. That's it. Then 35AD, asset used, you know, 35AD, no, 35AD section is for what section? 35AD, 35AD talks about what actually? 100% deduction, 100% deduction for capital expenditure other than land, goodwill, financial instruments. Except that, rest all other capital expenditure you can claim 100% deduction, correct? Now whatever asset you are purchasing, machinery, furniture, all that you can claim deduction. Only one condition, that asset must be used for 8 years for specified business. Suppose within 8 years you are using it for other purpose, then whatever deduction you claimed earlier minus notional depreciation you reduce, that amount will be taxable. And this whatever taxable amount is there, right, this is taxable, whatever is taxing, no, that is again added in the respective block. That's it. So by the way, sir, it's not about usage, sir. I sold it. I purchased a furniture for my hotel purpose, sir. I sold it. I got some 5 lakhs money. What about this? You sold within 8 years, after 8 years, that and all doesn't matter. You sold, you got money, directly under section 28 charging section, it is taxable. Amount receivable is straight away taxable. That's it. Then section 36, discount on zero coupon bonds. I hope you're able to learn new points, or at least all the dots are getting connected. Just reply me, say that dots are connected, instead of saying yes, no, say dots are connected, sir, or getting clarity more, something like that, so I understand whether you're getting more clarity or not. All the confusing points and all, I'm just resolving it. Somebody is asking advice for getting all India rank. Yeah, very simple. 5 months you have to study. 5 months. Only study, man. Apart from coaching, that is. Okay. At least with the coaching, if I have to say 8 months you have to study. With the coaching means 8 months you have to study. Daily 10 hours you have to study. 8 months, 25 days in a month, 8 months. That's the formula for all India rank. With the coaching. Suppose you want to get all India first and second and third rank, then 12 months you have to study. That's it. That's the formula. With the coaching, 12 months. For all India first rank, that's the formula. Remember, 12 months attested that too. Sir, I am studying for 12 months from past 10 attempts, sir. All 10 attempts, every attempt I studied one month. That is not 12 months attested. Yeah, thank you. Now, discount on zero coupon bonds. So, discount on zero coupon bonds means what? For example, face value of the bond is 10,000. No. Face value of the bond is 12,000. Whereas the company sold, the company gave the bond at 2,000 rupees only. So, discount is how much? 10,000. Now, this bond life is 100 months. From the date of issue, the bond life is 100 months. Then for each month, how much reduction? 100 rupees. For each month, how much reduction? 100. For example, in the current year, no, 24-25, we issued the bond on 1st October. Then for current year, 600 rupees reduction. Means 1st October to March, 6 months only. So each bond, 100 rupees into 6 months, 600 rupees reduction for bond. So this is how discount has to be calculated. Discount on zero coupon bonds, deduction has to be calculated on pro rata basis. This is what the meaning. Then, sir, company, no, our company, no, employees were there. They are participating in national pension system. Our company is also contributing. Okay, whatever is contributed, no, remember, if company is contributing to employee NPS account, for employee it's a salary first. Whatever we contributed, that much amount is taxable for employee as a salary, and he can claim deduction under 80 CCD subsection 2. Now, company is contributing, no, for companies and expenditure, right? They can claim deduction under PGBP, no, how much? Maximum 14% of salary. Now what is salary? Salary means what here? You see, salary definition again here it is different. Under 36 salary definition is different. Wait, going basic plus DA only, I think so. Commission is not covered, I guess so. Just 1 minute. Yeah, you see here, basic plus DA for retirement only. Okay, so 14% of salary, that much only company will get deduction, even though company contributed in the name of employee out of love and affection so much percentage, but company can claim deduction only for 14% of basic plus DA for retirement. Next, bad debts recovery. You know, first of all, bad debts recovery point, no, in many books the answer is wrong. Many books, recovery of bad debt answer is wrong. For example, no, here I have given numbers. This point if you understand, that's enough. For example, no, I wrote off in my books 10 lakhs. I wrote off in my books how much? 10 lakh. I showed bad debts 10 lakhs. I wrote off. But assessing officer allowed only 5 lakh. Actually my bad debt is 10 lakh, but assessing officer considered only 5 lakh. Means how much bad debt I claimed? Only 5. How much bad debt I ultimately claimed? 5 lakh. Later I recovered 5 lakhs, man. I showed bad debt 5 lakhs and later also I recovered 5 lakhs only. Somehow luckily I recovered 5 lakhs. I showed 5 lakhs bad debt, I recovered 5 lakhs. I already showed 5 lakhs. Whatever I recovered is fully. Sorry. Wait a minute. Yeah, correct. Okay. So how much is the bad debt of 10? How much is allowed by assessing officer? 5 lakhs. So first I sold goods. I showed income. Then I showed bad debt. Okay. Now I recovered. Bad debts is taxable to the extent deduction allowed earlier. Simple. Bad debts recovered is taxable in excess of deduction allowed. Okay, to the extent deduction is allowed. Simple logic you can take. Bad debts recovered is taxable to the extent deduction allowed. Simple. To the extent deduction allowed, it is taxable. For example, no, bad debts written off is 5 lakhs. Assessing officer, bad debts written off is 10. Assessing officer allowed 5, means net amount is only 5 lakhs allowed. Later 5 lakhs is recovered. Nothing is taxable. 7 lakhs is recovered. Only 2 lakhs is taxable. 10 lakhs recovered, then 5 lakhs is taxable. 11 lakhs recovered, then 6 lakhs is taxable. 4 lakhs only recovered, then remaining 1 lakh will be claimed as a deduction. Okay, I think no, I have given in-depth explanation. This point is very important. Bad debts recovery, this point is very important. You better see this point in our detailed revision. Detailed revision, you go and see. There I spoke about ICDS conflict, all that. I spoke clearly about ICDS conflict, everything. So bad debts is taxable only the amount in excess of net deduction. That's what the meaning. Okay, so better you watch the detailed revision. There I clearly connected, all the dots are connected clearly. There you just there you just figure out, because now there I told about P&L account, how it is operated. Like first when credit sale is made, what happens, then recovery, then bad debts claimed, what happens, then recovery is there, what happens. Clearly I spoke. Next, then okay, fine. I think all the deductions is completed. Now disallowances. This is very complex. You know, disallowances are again 2 types. In income tax, disallowances are 2 types. Temporary disallowances, permanent disallowances. Temporary disallowances. What are they? 40 subsection A1, 1A, 43B. These are temporary disallowances. 40A subsection 2, 40A subsection 3. These are permanent disallowances. Permanent. Like 40A3, what is this 40A3 section? If any expenditure, revenue expenditure is paid in cash for more than 10,000, if any revenue expenditure is paid in cash for more than 10,000, that entire 10,000 is disallowed, no more deduction at all. 40A2, if any amount of expenditure is paid to a related person, unreasonable amount is fully disallowed, no more again deduction later on. Permanent disallowance. Temporary disallowance, here the disallowance is linked with due date for filing IT return mostly, and in the current year if you did not comply with this condition, disallowance will be attracted. Subsequently again if you satisfy, again you will get a fresh deduction. So 40A subsection 1, 1A. 40A subsection 1 is what? 100% disallowance if at all any amount is paid to non-resident without deduction of or TDS deducted but not remitted within the due date for filing IT return under 139 subsection. Okay. 40A 1A is what? 30% disallowance. Regarding this, in the notes also I'll show you. You will have, amazing clarity you will have. See, 40A1 and 1A. You see here, within one page I have given disallowance in the relevant year due to non-compliance. Suppose TDS is applicable but I didn't deduct, or I deducted but not remitted. Then if at all amount is paid to non-resident or a foreign company, then 100% of the payment is disallowed, or the amount is paid outside India without TDS compliance, then also 100% disallowed. Sir, amount is paid to resident payee, sir, then 30% is disallowed. Okay, so current year you paid money, you incurred some expenditure. Current year you spent some expenditure. TDS you did not deduct at all, or you deducted but not remitted within due date for filing IT return. You deducted before 31st March, but not remitted before 31st October. Okay, 31st October means due date for filing IT return. For example, a tax audit case, non-tax audit case, 31st July. 31st March before you deducted and not remitted, that is non-compliance. Did not deducted by 31st March, that is also non-compliance. Non-compliance is two types: not deducted within 31st March or deducted but not remitted. You see, what is a non-compliance? Somewhere I've given TDS is deductible but not deducted in the relevant year, or deducted but not remitted within due date. Deducted means what? Deducted in relevant year. Not deducted in relevant year means not compliant. Sir, I deducted after 31st March, I deducted, sir. That's a next year compliance. For this year, non-compliance. So disallowance will attract 30%, 100% will attract you. Sir, subsequently, no, I again paid, sir. Subsequently, TDS is deducted in relevant year. Current year you deducted, applicable 31st, 24-25 year only you deducted, but not remitted within due date. Then for the current year, 100%, 30% is disallowed. Ultimately, allowed is expenditure in the actual year in which it is remitted. And suppose TDS itself is not deducted, you did not deduct TDS itself, disallowed for the current year, and ultimately allowed as expenditure in the year in which you actually deducted and remitted. Assumed compliance, this is regarding SSC not treated as SSC in default like that. This I think I clearly explained in detailed revision marathon. Here I just wanted to connect the crux point. That's it. Next. So 40A, 40A 1A is over. So here 40B, firms. Okay, firms, interest on capital, book profit, unabsorbed depreciation. For firms also, no, I recommend you to watch my detailed marathon. I already showed in the playlist. Inside this PGBP will be there. Okay, inside this PGBP will be there. Inside that firms discussion will be there. So you see here, firms discussion somewhere it will be there. Yeah, here only it will come. More in-depth explanation I gave, man. In this marathon, I'm telling you, you will have a lot of logic, you will have a lot of clarity. Okay, there you will get here. What I want to clarify is regarding unabsorbed depreciation under 40 subsection B. What I want to clarify is unabsorbed depreciation. There is one case scenario question in ICA case scenario booklet. Yeah, there is one case scenario book question. You know for firms, no, I'll show you. For firms, no, how to compute income under PGBP. First compute profit of the firm, okay, after allowing all deductions under 30 to 37, disallowances 40, everything you cover, everything you consider. Unabsorbed depreciation also you must reduce. If at all unabsorbed depreciation is there while computing book profit, unabsorbed depreciation must be adjusted. Be careful. In set off and carry forward, no, first priority we will give for business loss, brought forward, then unabsorbed depreciation. But in case of partnership, when you are computing book profit, first unabsorbed depreciation has to be adjusted. Brought forward business loss, hold it, don't touch it. Brought forward unabsorbed, reduce it. This is most important point. Case scenario, one question is there. So first compute PGBP income of the firm before interest reduction to partners, before remuneration paid to partners, whether working or non-working, leave it. In P&L account, sometime in exam, no, they'll give you P&L account. In the P&L account, remuneration is debited, working partner, non-working, whatever, debited. Interest on capital, debited. Add back all that. Add back disallowances. Compute income of the firm before reducing any payment made to partner. Then reduce unabsorbed depreciation, all that. Okay. Then first deduction is interest on capital, maximum 12% per annum simple interest. So from the income of the firm, reduce from the PGBP income of the firm, reduce first interest. Then what you get is book profit. On this book profit, up to 6 lakhs, beyond 6 lakhs, 90% or 3 lakhs, whichever is that and all logic. I hope you know. That's how it is to be. Then eligible remuneration, then you will get the balance income of the firm which is liable for tax. Here the point I want to highlight is unabsorbed depreciation. If at all in the given problem unabsorbed depreciation is there, we have to first reduce it when we are computing book profit. Sometimes, no, in exam, no, they'll give you book profit amount. If nothing is mentioned, we assume that it is computed book profit. Nothing is mentioned in exam. We assume that book profit is computed. Case scenario, one question is there. In ICA booklet, case scenario question is there. They just give book profit of 11,20,000. Nothing is mentioned. And when they're solving problem, they assume that this is computed book profit. Okay. Next. 40A3, 40A3A cash payments. 40A3 you know very well. What is 40A3A? For example, you know, any expenditure paid more than 10,000 in cash, more than 10,000 in other than prescribed modes. What are prescribed modes? Account payee check, account payee demand draft, prescribed electronic modes. These are permitted. If at all you want to spend more than 10,000 in a single day to a single person, this mode you have to pay, then no problem. Other than this mode you paid, cross check you paid, bearer check you paid, cash you paid, no deduction at all. But you know, I am following accrual method of accounting. 1st April 2024 to 31st March 2025, I am following accrual method of accounting. Accrual method of accounting I am following. In this year, I spent money. I spent, let us assume, 30,000 rupees I spent, or else let us assume 1 lakh rupee I paid. 1 lakh rupee, 1 lakh rupee expenditure obligation I incurred. I purchased goods worth of 1 lakh rupee on credit from one customer, one supplier. I claimed deduction in PGBP. You know what happened? This 1 lakh, no, the next year, like 10th May 2025, I paid this entire 1 lakh in cash. I paid entire 1 lakh in cash. What is the consequence? For 24-25, no treatment. Can claim deduction on accrual. But for 25-26 year, previous year 25-26, nothing but assessment year 26-27, this 1 lakh is treated as income under 40A3A. That is 40A3A section. Many know 40A3A, many very few. That too, September 24 exam, they asked a question where 40A3, 43B both are connected with MSMEs. Some adjustment, you know, such a complicated adjustment it is. Now look at. Okay, 43B. 43B, if you see, no, totally 7 payments are covered. 6 plus 1. One is linked with MSMED Act. Remaining 6 are linked with 139 subsection 1 due date. Nothing but 31st October 2025. 31st October 2025. By the way, for bad debts recovery, for depreciation, and for partnership assessment of firms, 40 subsection A 1 and 1A, nothing but TDS non-compliance disallowance 30%, 100%. For all of this, kindly refer playlist marathon which I already showed. There in-depth discussion happened. Okay, now I can't discuss in depth because time available is very low. You see, we are still at PGBP. 4th chapter only we are at. 5th chapter only we are at. We have capital gains, we have deductions, we have set up and carry forward, clubbing, TDS. So many were there. When you will finish that? Tonight it will not be over. Tonight I will cover PGBP. Maybe if possible I'll cover other sources or clubbing and set up and carry forward. Tomorrow I'll be covering capital gains. The next session I'll be covering capital gains, all that. Okay, it's not that easy. Next, I'll see that too. Okay, maximum here on I will only cover the crux points and then go. Okay, now 43B, one payment is MSMED. You know, 6 payments, no, like railway assets, interest on borrowed loan from banks and financial institutions, leave encashment, bonus, all these taxes, indirect taxes, provident for employer contribution to provident, all these are linked with 139. What does it mean? In 24-25 you spent that money, you paid within 31st March, 31st October, you paid within 139 subsection 1 due data, no problem. You did not pay within 139 1 due data, these expenses 6 items you can't claim deduction. That is one. Another expenditure is what? You are purchasing goods from MSME, or you are incurring, you are getting some service from MSME. To them you have to pay within 45 days time. To them you have to pay within 45 days time. That too, if written agreement is there. Sir, agreement itself is not there, sir. Then 50 days, 15 days is only the time. You know, one question came in September 24 exam. What is that question? I'll tell you. Beautiful question. Okay. 20th March 2025. Look at this number, 24-25 financial year, 20th March 2025 means within 31st March current year. Okay, SSE spent 40,000 rupees. SSE purchased goods from MSME supplier. MSME supplier goods purchased miles. How much it is? 40,000 worth of goods he purchased on credit. That to what? On credit we purchased. We purchased it from them. We purchased it from them on credit. Okay, what happened is, okay, written agreement is there. Written agreement is there. Okay, written agreement. 10th May, not even 10th May, let us assume 20th May 2025, this entire 40,000 rupees is paid. This entire 40,000 rupees is paid. No. Yeah, wait. 10th April itself, 10th April 2025, this entire 40,000 rupees is paid in cash. This is the adjustment. This is the question which they, and there no, we are computing income for 24-25 year. In P&L account, this 40,000 rupees is debited already, and this is nothing but a purchase of raw material from MSME. Okay, 20th March, 40,000 is a purchase on credit. Amount is ultimately paid on 10th April. Okay, now what is the adjustment here? Now 43B section says, for an from an MSME, if you purchase any goods and services, you must pay them within 45 days. If not paid within 45 days, then disallowed for that year. Okay, and actual deduction you will get in the actual year of payment. Here you see 20th March to 10th April. Here he paid within 45 days. No disallowance. Means 43B, that H point will not apply MSME because there is a compliance here, no disallowance. From 43B point, no disallowance. Now, it is ultimately paid in cash, no? Sorry. It is ultimately paid in cash, no? 40A3 will attract. No, it is paid in next year. In current year, you can claim in 24-25, you can claim deduction on accrual basis. The next year, it is treated as deemed income under 40A3. Under 40A subsection 3, it is treated as deemed income. So here 43B also did not apply. 40A3 also did not apply. 40A3A applied. This point also in the detailed revision class, I in-depth explanation given. Here also I gave decent explanation. I don't know how many of you know this point. If at all an MCQ comes on this, or a, in the total income question, PGBP based, if at all this kind of question comes, that's it. Be careful. 44AA, who all shall maintain books of accounts. You see, 44AA, many students have confusion. 44AA, many students have confusion. Very easily I have clarified, very easily I have given. MSME, micro small enterprise, definition, that is also important here. The May 25 attempt MSME definition is asked for 5 marks theory question. Be careful. Okay. Maintenance of books of accounts. Who should maintain? 4 categories of persons has to maintain. Who are carrying on notified professions, or persons carrying on business or profession other than notified profession subject to some conditions. Persons declaring income less than presumed to basis under 44AE. Persons to whom 44AD subsection 4 is applicable. Like 5 years logic they break, no, for them it is applicable. Now you see, notified persons. If at all in all the 3 years preceding years receipts are exceeding 1,50,000, then they must maintain books of accounts as per rule number 6F. Sir, others sir, like in all the 3 years 1,50,000 receipts not crossed, sir, then they should maintain books of accounts reasonable as per assessing officer request. Then other than notified persons, individual and HUF, in any of the 3 years turnover crossed 25 lakh or income crossed 2.5 lakh. Others means other than individual, then 1,20,000, 10 lakhs is the limit. Okay, any of the 3 years, any 1 year, if these limits are satisfied, they must maintain books of accounts. This is for other than notified professional. That's it. If books of accounts are not maintained, 25,000 penalty is there. In this, no, I wanted to highlight about this other cases. Notified professions, no, whether receipts are exceeding 1,50,000 or not, they must maintain books of accounts. If receipts are exceeding 1,50,000 in all the 3 years, rule 6 of books they need to maintain. If receipts are not exceeding, this criteria not satisfied, then they should maintain reasonable books of accounts. Rule 6 will not apply. Reasonable books you have to maintain, etc. So notified professions, whether they are satisfying the monetary limit or not, they must maintain books. If they satisfy monetary limit, rule 6 of books they need to maintain. If they are not satisfying monetary limit, reasonable books of accounts they need to maintain. That's it. So which means notified professions, whether matching or not, whether they are irrespective of any monetary limit, they must maintain books. Other than notified persons, any monetary criteria satisfied, only books will be liable to be maintained. If at all monetary criteria is not at all satisfied, books are exempted for non-notified professions. For notified professions, books are mandatory in all the cases. This is the crux point. That's it. My throat is paining. So we completed 5 chapters technically. Basic concepts, residential status, salaries, house property, PGBP, all confusing points one by one we are covering and then coming. especially total income, I explained very in depth because that approach is very important. Approach of solving total income is very important, where basic tax, everything, no, I clearly explained in depth. Next. Oh my god, 10:45 it is. Sir messaging me already, sir. Continue tomorrow morning like that. See? Capital gains, no, we will come back to this capital gains topic. Okay, fine, I will tell you what are the topics you must read in capital gains right away. Okay, here no, not much of explanation. Any crux point is there, I'll explain. Okay, capital gains, no, these are the sections 45 to 55a. There is no link with the default tax regime. Tax regime concept is nowhere linked in capital gains topic. You please read the reverse mortgage related discussion, theory, question, probability. Okay, capital gains on non-depreciable assets. Entire this capital gains, almost 2.5 hours revision is there in the same playlist I showed. No, part 1 income tax marathon, 12 hours marathon. Inside the 2.5 hours capital gains revision is there. Reverse mortgage, everything I covered. So you watch there. Capital gains. How to compute for non-depreciable assets? Full value of consideration, 50C point. Remember 50C point, full value of consideration. For immovable property, what is the consideration? If at all stamp duty value is more than 110% of, actual consideration, then stamp duty value. Otherwise, actual consideration will be the full value of consideration. Now, stamp duty value, which one we should take? Registration data, agreement data. If agreement is there, on or before the date of agreement, some amount is received by seller from the buyer by other than cash, then stamp duty value on agreement date we should take. That stamp duty value compare with actual consideration 110%. Suppose if that stamp duty value is more than 110% of actual consideration, then STV. Otherwise, it is actual consideration. Then reduce transfer expenses. Then what you will get is net consideration. From the net consideration, you have two deductions: cost of acquisition and cost of improvement. What is cost of acquisition? Actual cost at which the asset is purchased. Suppose, sir, asset is purchased from, asset is acquired from previous owner, sir, or previous asset is there, like debentures were there, now equity shares I got. Amalgamating company shares were there, amalgamated company shares I got. EGR receipt is there, now I have gold. Gold is there, EGR I have. So 49(1) modes, if at all I am getting any capital asset through 49(1) modes, then cost to previous owner, cost of previous asset is the cost of acquisition. Further, suppose no, if at all the capital asset is acquired by me before 1st April 2001, or previous owner acquired the capital asset before 1st April 2001, then cost of acquisition will be market value on 1st April 2000. Then cost of acquisition will be market value on 2001. And immovable property, in case of immovable property, this market value shall not exceed stamp duty value on 1st April 2001. And further, remember, if at all any capital asset is sold before 23rd July, indexation facility is available. Okay, and indexation as per Manjula Jesha case, you can claim from year in which previous owner acquired the asset. From that year onwards, you can claim indexation, because for holding period computation, previous owner holding period we will consider. And cost of acquisition of listed securities purchased before 1st February, like 112A assets. No, I purchased before 1st February 2018. This is very important for MCQ. This is very important for MCQ. Be clear. What is the cost of acquisition? Like listed equity shares were there, equity oriented funds were there, units of business trust were there. What is the cost? Higher of 1 and 2. So between these two, whichever is higher. Now, what is first one? Cost of acquisition or FMV on 1/4/2000 if at all asset is acquired. So whichever is higher, so that value. Compare that with second criteria. Second criteria is what? Lower of market value on 31st January 2018, actual consideration. So identify between these two, whichever is higher is the cost of acquisition. Regarding this, why this higher of 1 and 2? Again, in the second point, lower of actual consideration on sale and market value on 31st March. Why all this crux is there? I already told in the detailed marathon. Earlier, no, once upon a time, no, long-term capital gain 112A section itself is not there. That time, long-term capital gain is exempted. Later, from 1st February 2018 onwards, they brought it under tax net. That time, temporary, this kind of relief is given. This is history. Next. And cost of improvement before 1st April 2001, ignore. Cost of improvement for previous owner, we will take. Okay, but before 1st April 2001, ignore it. And there are some special cases like 45(1A), 45(2), 45(5). 45(1A). Generally, capital gains are taxable in the year of transfer. But in 45(1A), asset got destroyed by fire and insurance company paid money. Fire accident happened in 24-25, but insurance company paid money in 25-26. Then capital gains will be computed in 25-26, but indexation is available only up to 24-25. Conversion of capital asset into stock in trade. Capital asset I have, that is converted into stock in trade. It is taxable when the stock in trade is ultimately sold. I converted, capital asset into stock in trade in 24-25. Year of transfer is 24-25, but computation will be there in 25-26 or 26-27 whenever the inventory is sold. 45 subsection 5, compulsory acquisition of capital asset. It is taxable only when the consideration is received from the government. So 24-25 year capital asset is acquired. In 25-26 I received compensation, then computation will be in 25-26. But year of transfer is 24-25 only. Then exemption under 54, 54B, 54A, 54EC. These sections you need to please read. My full marathon is there. There you just go and then cover. Then slump sale under 50B. Okay, in slump sale, no, full value of consideration net worth. What is slump sale? Slump sale, how to compute capital gains? Full value of consideration minus net worth. Net worth is equal to capital gain. In slump sale, no, 36 months criteria. If the undertaking is more than 36 months held by us, then long term. Otherwise, it's a short term. Remaining all other capital assets, no, 12 months to 24 months criteria is applicable. Be careful. Okay, for capital gains, no, I recommend you to watch my marathon, because capital gains is so big topic, so complexity is there. I told right, those of you writing already who wrote in May 25, September 25, Jan 26, for these 3 attempts where the financial year is 24-25, capital gains is toughest. Again, May 26 attempt onward students will be writing, no, capital gains chapter will be easy, because no, before 23rd July, after 23rd July, that and all nonsense is removed from IC book itself. It is removed. So if at all you want to have an in-depth idea on capital gains, I recommend you to watch my full-fledged revision part 1. Inside that I clearly covered. Okay, now slump sale, full value of consideration. What is full value of consideration? Fair market value 1 or fair market value 2, whichever is higher. What is fair market value 1? Undertaking, one division I sold, right, its market value, or consideration I'm getting, right, some consideration, its market value, whichever is higher. That is full value of consideration minus net worth. Net worth is what? Depreciable assets, no, WDV value on 31st March block, close, WDV of the block, not 31st March, sorry, correct only, WDV on 31st March before claiming depreciation, that value. Okay, so WDV on 31st March, non-depreciable assets, no, book values. So this you total it, okay, minus outside liabilities you reduce it, then what you will get is called as net worth. This net worth itself is treated as cost of acquisition, cost of improvement. So consideration minus net worth is equal to capital gain. That's it. Section 46 here, buyback on or after 1st October 2024. If at all a company is buying back shares, domestic company buying shares, listed or unlisted, or leave it. Domestic company buying back shares on or after 1st October 2024. Whatever amount the company is paying, fully treated as deemed dividend. Fully treated as deemed dividend. Sir, this fellow purchased shares, no, what about that? That's the cost of acquisition. Full value of consideration 0. This amount is loss, will be carry forwarded. In-depth explanation I gave in the detailed marathon. Please go and check that. I'm just reminding you here. 50AA, capital gains for depreciable assets. I already told depreciable assets. 50 is talking about block of asset. 50 are talking about power sectors. Okay, 50 block of asset. If full block is sold, then gross block value identify. Opening plus purchases is equal to gross block value. Full block we sold, no, at some price. Gross block value 20 lakhs. We sold for 10 lakhs. 10 lakh short term capital loss. Gross block value 20. We sold for 30. 10 lakhs is short term capital gain. Sir, part of a block is sold, sir. But value, part of a block is sold for a price higher than gross block value. Then the extra amount is short term capital. Then 112A and 111A rates. So this you should see. So these are the points which you must see in capital without a failure. Do not miss these points without a failure. Okay, next. Income from other sources. Deemed dividend under clause C, E, F. C is about liquidation. Amount received on liquidation. E is about loan or advance, okay, to a substantial shareholder. And F is about buyback on or after 1st October 2024. Okay, in all these 3 cases, it is also treated as deemed dividend. Further, from the dividend, no, whatever expenditure you incurred, no, to get this dividend. Suppose, no, I borrowed a loan and then invested in this company. Now I'm getting dividend. Now whatever interest I'm paying on loan, borrowed loan, I can claim deduction. Maximum reduction is 20% of the dividend income. This point you should remember when you're claiming dividend deduction. When you're computing income from dividends, no, take income. See the expenditure, actual expenditure you can click, provided the actual expenditure shall not exceed 20% of the gross dividend. Interest on compensation, interest on enhanced compensation, flat 50% reduction. Remember, forfeited amount. Before 1st April 2014, the forfeited amount will be reduced from cost of acquisition while computing capital gain. If amount is forfeited on or after 1st April 2014, that amount is taxable under income from other sources. Okay. Yes, ma. Yes, I'm thinking of that only. I'll continue tomorrow. That's what I'm also. Okay. Then, gift taxation. There are 5 categories of gift. Cash gift, movable property, aggregate provision. What I will tell you is, for gift no in depth, for gift you LIC, life insurance policy. Okay, please refer my detailed marathon. Please refer my detailed marathon. And in post office no savings interest. Post office no savings interest. Exemption for savings interest from post office 3,500 exempt like that. Family pension. Fully taxable minus 1/3 of the pension received or 15,000 in case of optional tax regime, 25,000 in case of default tax regime. Deduction is available. These are the points which you must read in come from other source. See, only approach to total income is what mainly I thought of explaining, and salaries few topics. Rest all other no, I am asking you to revise. These are the topics you must revise at any cost. Clubbing provisions. I recommend 100% to read. So only 4 pages is there in my good notes, and that is already covered in my marathon also. Please go and watch the marathon clubbing directly. Okay. Now here no, I just want to highlight one point. Suppose no, income is getting to the spouse on gifted asset or cash. Okay, like I gifted her some jewelry. Okay, and that jewelry she sold, you got capital gains. That capital gains is also subject to club. Generally what we think, income on gifted asset means interest income, like that only we think. Capital gains is also an income on the gifted asset, so that is subject to clubbing. That is subject to clubbing. And minor income, and it's okay, income to gifted asset no. Suppose no, I gave cash gift, and that cash is invested by her in proprietary concern, then in the ratio of capital on 1st April of the respective year. So in that ratio, for that year profit ratio, like for that year 24-25, how much profit she got from the proprietary concern. Numerator, how much opening capital from gifted asset is there, divided by total opening capital, how much. That much amount is clubbed in the hands of the other spouse who gifted that. Suppose no, I gifted house property to minor married daughter. 27 deemed owner will not apply, but 64 will apply, and 1500 exemption is there under optional tax. Sir, I gifted house property to some other minor, sir, not minor married daughter. 27 will apply. The concept of 1500 deduction will not apply. I hope you're able to connect with all this. Okay. Set off and carry forward. I recommend 100% content, which I already covered in the playlist. I'm showing you playlist here. You see, in this playlist, this set off and carry forward is there already. Set off and carry forward. I recommend you to watch this. Here 12 hours revision is there. You don't have to watch the entire 12 hours. You can easily quickly finish, because many concepts I covered in this marathon. In this particular revision I already covered. Chapter 6 deductions. These sections you need to remember. Under optional tax regime, all deductions will get, whereas under default tax regime, these deductions only you will get. Chapter 6 here. 10AA deduction you must read. ATC important list. What is important list in ATC? I will show you. Okay, what is ATC? I will show you. A minute. Just 1 minute, ma. You go to my GOAT notes. Important list I highlighted with gray background. ATC. ATC I highlighted with gray background. Premium paid on LIC, gray background. You can see here, gray background. Again, contribution to Provident Fund, contribution to Sukhana Samriddhi Scheme, contribution to National Savings Certificate. Then we have tuition fee paid for 2 children. Okay, in Indian schools, in Indian universities or schools. 15th, payment for purchase of house property, principal repayment, all that. Then investment in 5-year term deposit, contribution to additional account, Tier 2 NPS. Tier 1 NPS comes under ATC series. Tier 2 NPS comes under ATC. So ATC important list means that only. Okay. Next, ATCCC you must read, ATCC you must read, ATCCE overall limit you must read, ATCCH you must read, ATD. Maximum answer will be 25k or 50k or 75k or 1 lakh. This is the maximum answer that you should get. ATDD, ATU, flat 75 or 125. ATE, these are the sections you must read. ATQQB, RRB, you can leave, not an issue. See, they're also important, but if you have time, you go and read that. If not, it is enough. But remember, in the marathon which I showed, no, 12 hours marathon, I covered all these chapter 6 deductions, ATG, everything I covered in depth. So these are the sections you must read. This document is what? This document explains you what this 6 pages document explains. First approach to total income and what are all the topics you must cover before exam. That's why you see the heading. Must read topics before exam. Next, in TDS. Okay. Watch section combinations. In this PDF, I gave a link. You just click this section combinations. You see 3 minutes video is there. Okay. Just a 3 minutes video is there. So 3 minutes video, there are some section combinations which you need to understand. So that you must read compulsorily without a failure. And even in capital gains also, no, rates and dates like that, one concept is there. Concept is the rates and dates. You see here, rates and dates. So this concept you please go and watch compulsorily. 6 dates, 6 rates which are relevant in capital gains, that you must. Next. So these are the sections. 80JJAA, I recently there's one important adjustment in case scenario. Suppose no, in 24-25 we recruited some additional employees, or in 23-24 last year we recruited some additional employees, some 30% deduction, we got 1 crore. The same 1 crore will be claimed in 24-25, 25-26. So whatever deduction you claimed in 23-24, same amount you will claim in 24-25, 25-26. Nothing but 3 years you will get deduction. No, that is same amount. Then in TDS, TCS, no, these sections you remember, these sections you revise. That's enough. You don't have to touch other sections. I'm telling you, 192A, 194A, 182A is regarding RPF withdrawal, interest, 194C contractors, professional fee, commission, 194I rent, 194IB is also rent, monthly 50,000 or more, 194IA immovable property purchase more than 50 lakh, 194M contractors to professional fee and to all of them commission or brokerage where it is paid for more than 50 lakh for personal purpose, all that. 194R perquisite, 194 and cash withdrawal, 194Q and 206C 1H. This is regarding 194Q is regarding purchase of goods, 206 is applicable for seller of goods. Okay, and you know what? 206C 1H is removed. May 26 attempt, not for you. For January it is there. Be careful. And 206C 1G in TDS, TCS sections. TCS section 206C 1G. LRS, liberalized remittances, education purpose, other than education, overseas tour package, that discussion. Don't worry. I showed right in playlist. It is covered in depth there. Okay. See, I'm concluding this video. I don't want to extend again for part 2. You can directly go with, you see, that's why important sections in TDS and TCS I told. Interest on late deduction and late remittance under 2011. Higher amount of TDS for 206A, 206CC. This you can. And advanced tax exemption for senior citizens. Advanced tax is exempted for senior citizens who do not have PGBP income. 234B, interest is calculated on assessed tax. 234C, interest is calculated on written tax. When you are computing 234C interest, 12%, 36% exemption is there. First installment, second installment shortfall, you will not calculate interest. If at all, at least 12%, 36% advance tax is paid. Be careful. Then return of income, 100% of the content is recommended. For return of income alone, I will do a separate revision class. I will do a separate revision class tomorrow. Okay, I will upload a separate revision class for return of income. That's it. Then AMT and total income, I already covered at the beginning itself. At the first discussion itself, AMT is covered by me. That's it. So this document will give you what are the minimum sections that you must study, minimum concepts that you must study in every chapter, and what are all crux and confusing points I clarified you. That's it. Okay, but remember, this is not a detailed revision marathon. This is only a crux point marathon where and all you do mistakes. All those points I think I reminded. I think I didn't leave any point where you generally do mistake. All the points where you generally have confusion, I connected all the dots. That's it. Okay, so watch my playlist marathon. So here playlist marathon is there, right? So in this playlist, no, part 1 is there, 12 hours. This you can watch. Part 2, in-depth discussion will be there in TDS, TCS, everything. Trust me guys, these marathons, no, that is 12 hours plus 2.5 hours, 15 hours, both put together 15 hours. Remember, this video, hardly we started at 7, right now 11, it is, 4 hours, in between 1 hour break. 3 hours only we covered this much, na? 15 hours marathon. How much will be there the content? Imagine. So all the things I covered. Then somebody is asking any important theory 4 marks question. There is so much of theory that is there in income tax, but not required Yashwant. Okay, that's it. So all the very best for tomorrow, day after tomorrow for tax exam. Go ahead, do well, and tomorrow I will upload return of income revision class also. And after this, no, Muhammad sir GST related class is there. 20 marks portion he gave, 2 hours video or 2 to 3 hours video he gave, 20 marks coverage will be there. That video also I'm going to upload tomorrow morning. That's it. Okay, all the very best. Bye bye, take care.